Good morning. Welcome to Trade Live with IG with myself, the weatherman, and Chris Beecham.
Brought the weather back with you. Clearly, it's been awful the last 2 days.
Oh God! I watched you and Aaron on Monday morning, and I'm like, guys, come on! It's not a weather forecast.
They said he was shouting in my ear, talk about the weather.
To be fair, yes, there it is. That is the end of July in London. Beautiful. It's not grey skies. It's just pollution, people. Don't worry. All you guys up in Sheffield and Wales, you lucky beggars, you.
You came back full of diplomacy then as well, clearly.
Oh, yes. Right. What have we got coming up on today's show, Wednesday the 30th of July? Well, it's the busiest 3 days in financial history. So, Chris Beecham's going to run that through everything we've got coming up in the next 72 hours until 8:15 this morning. Then, a good friend of mine, Tom Price, is coming in, ex-head of commodities research at Macquarie. And if you're head of commodity research at the biggest Australian bank, then you are head of commodity world.
Commodities. Yeah.
Tom Price is going to be joining me for 20 minutes, giving some of his fantastic opinions. Made me a lot of money in Macquarie, so very good to have him in. Charting crypto. Now, who's doing charting crypto today?
Let me think, who's doing that? Oh, wait, it's me again. Hopefully more success than last week because we think we've solved the Wi-Fi problems. So.
Oh, yes, of course there was, wasn't there? Then at 9 a.m, I'll be back on your screens telling you about all the stocks that should be going down that are too high. And then at 10 past 9...
They don't go down, do they? Very funny.
10 past 9, we've got the second episode of our latest and greatest podcast, The Art of Investing. So, we are at the beginning of the end. Of the new world.
Of everything. It's one of those weeks where everything happens, and then you've got probably 4 weeks in August where nothing will happen.
But doesn't it excite you?
Yeah, it is. It's great fun, but you're trying to keep track of this, and you just think there should be a limit on the number of companies that report every day, certainly in the FTSE, because it's one of those days where everyone decides to have a trading update or earnings report, and it's just...
We've got Rio Tinto, GlaxoSmithKline, Glencore, HSBC,
BAE, Taylor Wimpey, International Personal Finance. There's a bid for that as well. I saw.
Right.
So it is all kicking off all week.
Of the next 72 hours, what, as a bull, what scares you the most?
What scares me? Oh.
Yeah. What's the most dangerous figure?
I think it's going to be the earnings. So I think with the Fed, you'll get probably they'll get a couple of dissenters angling for the top job, basically, that will call for a cut. So that should be all right, I think. I think it's just the possibility that people just sort of aren't happy enough with the Apple earnings and the Amazon earnings and all that together. Just people, I think that's where maybe payrolls a little bit as well. So
I think Apple's already kind of touted to be weak.
Yeah.
So they've maybe got the lowest bar.
Yeah, and most of earnings season has gone, again, people have stepped over the surprisingly low bar that has been set. So, that's just how it works. So that may be payrolls if there's a bit of a jitter. Because the market seems particularly sensitive at the moment to worries about job growth.
As the biggest bull in town, what's your trump card there? What do you think is going to send this market higher?
Well, never short a quiet market, and this is still, volatility is so low that you've got, the risk is well, actually, the one thing that does bother me is if you look at August in second terms of Republican presidents, there's never been a positive one. It's not a big data set, so I wouldn't hang your hat on it, but it's just interesting to note. And there's that is there just a bit of exhaustion creeping in?
It certainly felt like it the last 2 days. We've
just pushing on a string, aren't you?
Yeah.
You're picking above 45,000, and it's just, but what else is new?
Or in new money, 6,400.
Yeah, exactly. Yes, if you insist on following the S&P, but Dow's much more fun, more exciting.
Funky Gibbon, exactly. That is the question of the day. Is the market looking a bit shaky? And maybe not shaky. It's just found it really hard to go higher the last 48 hours. But we are coming into the busiest 3 days in history. So
But we'd be careful, because every time you and I go on here and tout this is very important, nothing ever happens, and it's always something else that happens. So usually when the market's looking for something, it doesn't transpire. Markets don't play ball in that way, really, do they? I mean, you might get a shocker over the next 48 hours from somebody.
And as traders, because this show is made by traders for traders, watch for the things that everybody else isn't watching the next 72 hours, because that's your opportunity.
Yeah.
Is the little profit warning that gets sneaked out, or the good UBS numbers because they did the biggest corporate theft in financial history.
Anyway, let's not excite the UBS legal department too early on a Wednesday morning.
Right, let's go into overnight action. So good morning to you all. Andrew McKelvey on it. There we go. He's a busy man already this morning, telling us that have they still not got their vowels back?
No, I think he's just quoting the Epic code. They're back to Aberdeen.
Okay,
yeah.
ABDN increased their EPS by 10%. SWC we were talking about yesterday, having a little update on those. Have bought another 225 Bitcoin, now up to over 2,000 coins. We've got Parky77 in. Funky Gibbon, R6Ena, joining us. Good morning, R6Ena. Thank you for the welcome back wishes yesterday. And to Julian as well.
You've not mentioned my favourite comment in the morning. Go back up.
Oh, gotta go back up.
Thank you, Jesse14. Thank you very much.
Nice pop in oil yesterday. Well done, Chris Beecham, on stealing Axel's trade of the week.
It's not even his, because he's been away. So this is
he messaged you from holiday and he said,
"Oh,
go on,
it's got an earpiece." Yeah, I just no, exactly. I think this is off the Trump stuff. I think is the best explanation we've come up with. Is the fact he's once sounding vaguely tougher on Putin and the possibility that you get some sanctions. So it's given oil a bit of a pop. And it's just an example of look at price, and the price is telling you something, and there you've got your pop in oil prices. So I'm happy with that.
Now we should, once we're talking about Russia, we should talk about the earthquake this morning. That's 8.8.
The sixth largest in history, as far as they can,
really,
as the data suggests. I haven't seen, because it was meant to hit Hawaii about 10, 15 minutes ago.
Right.
The tsunami, use that term advisedly, but that's obviously the warning that's been issued.
Well, yeah, there was a warning. I don't think they actually spotted one, did they?
No. Well, they're definitely seeing an impact in the wave data.
Yeah. So yeah, off the Kamchatka Peninsula, that's the far east of Russia, an 8.8 on the Richter scale, which is huge, and then was it a 4 meter tsunami, producer Phil? Yeah, 4 meter tsunami. Scary stuff. So we'll keep our eyes on that, but. We have plenty to go through with all the numbers today. Which one would you like to start with? Vodafone, that is. So away from the numbers saying harmonic averaging alive and well. I sat with my little whiteboard yesterday and taught our CFO about harmonic averaging. And
good.
He said, I can't believe it's that simple. And it really is. But these banks are just creaming it, absolutely creaming it. It's almost like it's impossible for them to miss the VWAP.
Well done, you, on the 3 busiest days in markets, and you're going to talk about Vodafone.
No, we're just away from the numbers saying yesterday's volume weighted average price paid per share 82.96, 4 million shares bought back. But talk to me on which number stands out to you. Which numbers stand out?
Gosh. I think in terms of heavyweightness, you've got to look at GSK, haven't you, really? That's your opening, because it's said AstraZeneca. Right. It's a big 24 hours for healthcare, because you had Astra yesterday morning, which was okay. Mm-hmm. You had the shocker from Novo Nordisk, which we should talk about in a minute, because I think they might be cheap if you look at the valuation.
Well, it does sound like the earnings were only cut 5%.
And I was looking at the earnings on Bloomberg. The earnings just continued the profitability's gone. Now, obviously, that's backward looking, but it surged. And you had a stock that was at 39, 40 times earnings exactly a year ago, and there was all the euphoria.
Yeah.
And we're going to go in the US and China, blah, blah, blah. and they've lost 60% since then. So they've gone from 39 times earnings to about 11 to 14 times earnings.
Really?
Yeah.
Okay.
Which is, it's not, we're not going to use the phrase screaming buy, but it's that kind of makes you go, is the market now just too bearish? We've gone...
Baby with the bathwater.
Exactly. If we've gone from greed to fear in the space of a year, and now maybe it's that time to think, okay, and it's delivered fantastic returns in the last decade. It's just the clear run up and the euphoria around it. But there's GSK. It's not a bad set of numbers, really.
Yes. So we've got forecasts. The guidance is they are going to report towards the high end of the range for 2025. They are very comfortable, and that includes all the tariffs as well that have been announced so far. You had an EPS of 47 cents for the second quarter, and that was up 15%. 15% for a pharma company is pretty impressive.
It is. It's really impressive, yeah. And then we can talk about HSBC. 30% drop in first half pre-tax profit.
Hang on, let's
Sorry, I can keep reading them there.
Screen off, guys.
A strong underlying performance in wealth and markets, and it's boosted its dividend, and it's announced its own share buyback as well.
Off, please.
So a good set of numbers there from HSBC overall, really. Obviously, the first half profit quite weak there, but it still sounds like a bank that feels relatively confident. The boost of the payouts. The key one with HSBC, because it's not the greatest performer in the world in terms of its share price, but a great commitment there to increasing its payout.
Yeah, compared with Barclays, it's been relatively disappointing over the past 18 months, hasn't it?
Yeah, exactly. I mean, it is its highest level since the financial crisis, though. So that's interesting. We've finally got the 2009 highs around $55, so we're through that now. So it's a good performer since the pandemic lows, actually.
As has UBS, another one reporting this morning. So strong numbers there, and really good in leveraged, leveraged deals, leveraged banking. And they asked the CEO, has that continued into the current quarter? And he said, I won't be pushed on that, but you can see markets are up 30% from the lows.
Yeah.
Nudge, nudge, wink, wink. Things are good.
Yeah. Everyone's happy with that, really.
Yeah.
So again, thanks. Very, very good performers out of earnings season. Globally, you've had NatWest and Lloyds reporting good numbers. So banks in the UK seem to be in a very healthy position overall.
Here we go. So HSBC in Hong Kong down 3.6%, the lowest since July 16th. And so that's the good thing about HSBC. You always get a look in Hong Kong of what they'll do
before you buy.
London Open.
The share price is up 40% over the past year. So pricing in quite a lot of goodies. It's only 12 times earnings and a 5% and more yield. Very, very juicy from that perspective.
See if we can get this. Here we go. Wow, you don't want to have poor numbers after that.
No, and that's the key thing, isn't it? Really, that they've navigated that quite nicely. Because if they can, I mean, obviously, I don't know what the forecast is for where they're supposed to open, but you like those. I think they could be happy with that.
Yeah. Would you rather own those or Rolls-Royce, considering they're pretty much exactly the same share price?
I think I'd probably at the moment rather.
I'd take HSBC.
I think I'd take HSBC because I just think Rolls is...
It's done it all.
It's done it all. But then BAE this morning as well. BAE reporting saying sales up 11% and underlying earnings up by 13% in the first half of 2025. Sorry, this is one of those mornings where you've just got to
be working me hard this morning
everything.
Getting all the news up.
I know.
And Terence outside as well.
Sorry, everybody. They said it's supported by broad-based, I can read very slowly if you like, sector growth and strong delivery on defence programmes.
Right, so upgrading its annual earnings forecast after strong first half results as it continues to benefit from countries raising military spend. BAE said it expected annual underlying earnings to rise between 9 and 11% on last year's result, higher than the previous 8 to 10% guidance. Earnings jumped 13% in the first 6 months of the year. Yeah, what's the stock up?
Over the past year,
200%?
40%, up 270% over the last 5 years.
Okay.
But trading at 28 times earnings, that's a bit chunky for a even with a defence company that obviously where spending is going through the roof, certainly, or supposed to, really. 30 times earnings for the last 12 months, and just to, so again, this is what we're saying with BAE and Rolls-Royce. There's a lot of good news priced in there right now.
But you've got probably, after AI, defence is the biggest.
Yeah. And in the client survey, the IG clients, what sectors will do well? Defence was very much in there. They're very keen on that at the moment.
Because it's almost guaranteed, isn't it? Like if the governments have signed up to 3% of GDP, then it is 3% of GDP for the foreseeable.
And it's very hard to backslide from that with Trump in the White House.
Yes. So you wouldn't necessarily see it go much higher from 28 times earnings, but I also can't see it going much lower.
No, and so it's a question of how, if there is weakness in this one and in Rolls-Royce, how far does that weakness go before somebody thinks, actually, no, I still like this? Because if you're starting to price them as growth companies, which maybe they are as a sector, then they might deserve that higher rating. It's always a dangerous thing to say they deserve it, but maybe they should be more befitting of that kind of evaluation at the moment anyway.
And it sounds like you'd certainly rather be in that than when you're digging iron ore out of the ground, because I don't think Rios were particularly great. Right, Rio Tinto, smallest H1 underlying profit in 5 years as iron ore prices remain subdued.
Oversupply, there's the word you never want to read in a mining update.
Yeah.
Too much of the stuff.
And they were talking about China as well being a source. Besant, that's what Besant was talking about yesterday. But it has reported underlying earnings of 4.81 billion for the first 6 months, missing the consensus of 5.05. So not good numbers from Rios. Just as well, we've got Tom Price coming in, the Rio Tinto expert. They can tell us his thoughts on iron ore and on Rios at the moment. So, right, next, we've got Porsche talking about a 6% decrease in sales and 67% drop in operating profit. Right now, we see why the stock has been so poor.
And if we're on that, Aston Martin lowered its 2025 ambitions as well after high US tariffs disrupted operations. Margins roughly in line with last year, but not as high as the 40% they wanted. And they worrying that adjusted earnings may no longer be positive for the year and instead may improve towards break even. So cars.
Stellantis yesterday as well. We had the oh dear. Here we go. Stuttering Stellantis braces itself for $1.5 billion US tariff hit. So this article just read absolutely terrible. Absolutely terrible.
Net loss of 2 billion.
Stellantis, Renault, European cars, no thanks.
Across the board. Aston Martin listed at £40 a share. What is it today? 78p.
I bought it at 40.
Did you?
On day one.
The story
Start off, guys.
The story was there, but you could, like Ferrari.
Yeah.
Oh, Aston Martin. Yeah, of course they do well. Luxury goods. What? Impervious to recession? What could possibly go wrong?
I lost $200,000 on my prop book on the first day because it was an IPO. All the autos analysts were saying, yeah, this is going to be great. How could they possibly be so wrong?
Yeah. The story is, it looks like it should work, and it just never. Did they overprice it? Did they sell it too hard?
Autos and airlines never fail to amaze me at how they just cannot make money properly. No.
Buffett's point, isn't it? If you add up all the money made and lost in airlines since the invention of the aeroplane, it's naught. Buffett always said if you'd known, you would have shot down the Wright brothers.
Well, as an investor.
Yeah, as an investor, you would have made sure they never took to the air because
Yeah.
there's so much money lost in airlines.
Yeah. Speaking of which, you're about to jump on an aeroplane and go off on holiday,
We're not
aren't you?
flying, we're just tootling down the road to Somerset. So,
Looking forward to that.
yes, very much so. Just need to get out and smell the sea air, sit on a beach.
Gonna dial in for us?
Yeah, definitely. No, I'm not as bad as you. I thought you'd be watching on a Monday.
Oh, it definitely was.
I should have given you a shout out, really. And the coordinated shirts as well. Did you like the fact we're both in pink? That
Yes.
morning as well?
Very good. Right, let's have a look at the front page of the Financial Times. We've got the Wall Street gears up for pivotal 3 days. Pivotal because it's going to go down afterwards for US markets. So it goes into a deep dive, everything that is happening there. Then you've got the story on the tsunami there. Fingers crossed that leads to nothing. You got the story on Novo Nordisk, down 22% in the end yesterday.
Yeah, hugely popular stock.
Yeah.
Amongst clients, very much in a new stock. And I don't know how big it is, but it's weighting in the Danish index, isn't it, or something? The Copenhagen.
I think it is Copenhagen. Yeah,
The famous Copenhagen stock market. But yeah, really interesting story of how markets go from euphoria to don't want to touch it with a barge pole. Interesting enough.
Always a good one to do a social post on Novo Nordisk.
It is actually, yeah, it's a good idea. It really gets people talking.
Yeah. Right, then, we've got the HSBC story, we've got UBS, and what else did we... I thought we had something else interesting further down.
Good stat away from the numbers. Biggest one-day drop for Novo, 23%. 57 billion off its market value. Oh, that's a good one. Of what other companies of that size?
Here we go. Mercedes-Benz also.
Oh, yes.
And Starbucks. So Mercedes-Benz cutting guidance on the Trump tariff impact. This, as we say, it's one of those days where it's just so busy.
It just gets ignored, doesn't it? But this is the point. If earnings, it's not just one sector. It does bother you with markets at record highs. All these earnings coming through being not great.
Yeah.
At best.
If you're not in AI,
Yeah.
then the market of everything else is not going higher. It's the heavyweights.
Yeah.
So if they don't perform
Yeah.
in the next 48 hours, then we're going to be in some real trouble because those share prices are high.
They are. And if you saw the S&P go back to, I don't know, 6,200, 6,100, that would feel like a big move. But it would be enough, I think. It's the kind of thing, if I think it's going to go higher into year end, but I almost wouldn't like to see it just not stop. Because if you get another 2017 and 2018, that's when you get your volatility. You need to have these corrections, these pullbacks for a healthy market. This has to function that way.
February 2018
Yeah.
feels very similar, and that is when vol went from 17 to 37 in the space of 24 hours.
Yeah.
That was not fun.
You had a whole year, of course, in 2017 of it just going up. If that replays, okay, fine, fair enough, but you've got to pay the piper at some point, haven't you? You have to have that volatility.
Yeah. Right, we are going to go and guess the chart. What country is it? Because it's Phil. It's a US stock, and then we have indications from all the companies reporting. And Aston Martin down 2% is the one I'm
You
going to
can't really smack it anymore.
Right, US stock, which one is it? Fastest finger first. Are we ready? I won yesterday. Come and beat me. Let's go. Well done, Funky Gibbon. Nailed it long before I did. But Chris Beecham smashed it.
I got it.
Well done.
Meme stocks. So there you go.
Yeah, enough of the meme stocks now. Let's stick with the proper stocks.
They're exciting, though. They're fun.
Yeah, it certainly allows you to identify the chart, doesn't it?
Yes, it does. Yeah. Massive short interest as well. Yeah, that kind of thing.
Right, let's get on to early indications then. British Aerospace, BAE Systems, up 1% on numbers. 1% on numbers. Glencore, up 2%. So a 1 billion cost saving coming through from Glencore. Up 2%. GSK, up 3%. Good Q2 results. High end of guidance for the year and looking up 3%. HSBC, the opposite, down 3%. HSBC, even with a share buyback of $3 billion, they are looking down 3. We've already had them down 3 in Hong Kong. Taylor Wimpey down 2. We haven't covered that yet. H1 results, revenue 1.65 versus an estimate of 1.64. And pre-tax profit of 148 million. I did laugh. The CNBC were talking about Hermes this morning. Mm-hmm. And they said, Hermes misses estimates. And the estimate was 3.10 billion, and they came in at 3.09 billion. It's like,
you still missed.
Please. That is not a miss. Aston Martin down 2. We've covered that. Aberdeen unchanged. We saw net outflows of 900 million there, but the estimate was 893. Man Group up 2. Wizz Air unchanged, raised to buy at Deutsche Bank. Foxtons have had numbers. Foxtons revenue H1 86.1 million, profit before tax of 10.2.
Another fallen angel, Foxtons. Sorry.
Reiterates full year guidance and has got a couple of minis for sale. if you want a mini there.
And a couple of gratuitous downgrades this morning of Novo from Barclays and Oddo. So this is a bit more of an after the fact kind of event.
Right, it's almost time. We've got time. Let's have a quick look at the futures then, see where they are. They're yet again a soggy day yesterday. 6,380. We did get down to 6,372 at one point, I think.
Yeah.
Tech was all right. Tech outperformed. We had a strong day. Just everything again. Palantir was up. Nvidia was up. AMD was up 4. And we just saw them sink back. AMD, I actually shorted them yesterday.
Did you?
So now short Nvidia, Palantir, AMD. I didn't short the stock. I shorted the 200 calls for September. But you short, how much do you think you take in for shorting 200 calls for September in AMD? Stock's trading at 180.
Not much.
7%.
Huh?
No, sorry, not 7%. $7.60.
$7.60.
$7.60.
Okay. Yeah. And vol was at a lowest level on ours since late Feb. So it's interesting that it's just a little bit too quiet, a little bit too easy at the moment.
And this was the problem in 2018. Everybody was selling puts, right?
It works until it doesn't.
It works until it doesn't, because you go, oh, well, this is easy. Market never goes down. I'll sell some puts. That's free money. And then...
What's that sound? Oh, it's a steamroller in the background. Yeah.
Right. Do you want to pick up your bell there, Chris? Give it a little...
Can you say that to people early in the morning? I don't know.
Tinkle. That was a very... There wasn't much energy in that.
Well, it's like the weather this morning. I mean, come on. But the market at least will provide us with plenty of fun.
Right, we're there. We're up and running. What is your favourite stock of the day? Let us know. What do you want to talk about? What do you want to hear about? Because there are so many numbers. What do we think the worst performer is going to be? Lloyd's is a good one. Lloyd's 79.60 now. It's just creeping higher and higher and higher. Barclays...
Stinker of the day. Taylor Wimpey.
Is it?
Down.
Barclays, has it had its run now? We saw we hadn't talked about it earlier. Somebody did say
buybacks.
Somebody said, don't forget about Barclays.
It's probably producer Phil, because you never pay any attention to him. But
it was Andrew McKelvey. Andrew McKelvey, don't forget Barclays. Excellent results yesterday. Yes, they did. But have they had most of their move now?
It's been a fantastic ride.
Perhaps there are better opportunities elsewhere in the short term. GSK up 1.3. Go on, Glaxo. 14.14 there. BP up to 409.
BP and Shell both up this morning on that oil move, doing a lot for them.
Nice. God, why didn't you speak about them in Trade of the Week? Reckitt's up 40 basis points. Diageo, but let's go to the followers. Let's see the excitement. Where is it? It's there with Urberdon.
We need to get that changed.
Yeah. They really do need to get that changed.
Inflows of vowels, but outflows of money for Aberdeen. So there we go.
900 million outflows. So Standard Life down 2.5%. Rollers, there it is, down 1. Oh, it was above 10 quid again.
Turns out it can go down as well as up. But there we go.
Coming into land nicely, Rolls Royce, Vodafone 82.80.
So outside the FTSE 100, it's Taylor Wimpey down 5.5% now from this morning. So
down 5.5 Taylor Wimpey.
Very ugly set of numbers, I think, today. I'm just trying to find it now. What did they say?
Barclays just got hit 2% from when we started talking about it.
That's producer Phil hitting the bid.
So I tell you what, some market maker has just been absolutely lumped in, I would say, this is when you get the old sales trader shouting across to you, Rich, where would you make Barclays in $20 million to start an order? And you bid them 372 as they were there, and then smash, you're 1.5% offside before you blink.
Ouch.
And there is your $300,000 loss for the day, sir, by 8:10.
Did we cover Taylor Wimpey? We didn't, did we? Swung to a 90 million loss because of a massive increase in cladding fire safety provisions.
Oh, that's horrible stuff, the cladding.
Softer market conditions in the second quarter, but expects full year guidance, still reaffirm full year guidance. So,
I invested in some properties. This great thing, they buy the property and they put them into 100,000 shares. So you can buy a small amount of properties.
I think I know the company that does that. Yeah,
London House Exchange, I think it was, and it's been a disaster because they had probably 6 properties with cladding, and there's just no bid.
No.
You can't get out of it. No. So yeah, great idea with buying the properties, put them into, decimalize them.
If you go to the monthly chart on Taylor Wimpey, it's interesting because if you look, markets love round numbers, 100p a share, £1 a share was big support in 2020 and in June of 23 and in April. So there's your first level to watch really there, the big round number.
It's been a shocker though, hasn't it?
It has, just house builders. It's again counterintuitive. What could go wrong in house builders? That house prices go up, they don't build enough. Surely it's a license to print money. Turns out it's not. Aberdeen off 3% now.
Vistry the same, Persimmon the same. BAE down 1.8. There they are. You can have good results, but at 28 times earnings, there's always the risk to the downside. Is that a precursor for what we're going to see in the Magnificent Seven in the next 48 hours?
Yeah. For Expo, of course, no doubt off that Rio Tinto stuff, really. One to watch.
For Expo, of course, down 3 there. Well, I wonder if they've got mines across in the east of Russia. Don't know. Rio's down 1.2%. We're going to be speaking more about Rio's with Tom Price in a couple of minutes. I can imagine him sipping on the coffee. Just can't wait to get into the studio. Outside the door there. JD Sports down 1.1%. We've got, all the house builders are getting clumped. Barrett's, Berkeley, Vistry, Persimmon, all down in. And there is AstraZeneca unchanged. Shall we take a look in Europe? What do we think for Mercedes?
Only if we do it like
Porsche? I could not predict what those are going to be because they're already so beaten up.
Yeah. Time to buy.
Let's see.
No advice.
Oh, Adidas down 7. No. Oh, the pair trade of.
Oh no, were you long that?
No, long Nike, short Adidas. We've got a bloody advert on it, and I don't have it on. That is a 25% pair trade now.
Why didn't you do it?
We've said for months the Adidas shoes now all look the same. They haven't come out with anything new from your Campus, your Specials. They haven't come out with any new for months, and the fashion's done. It's, you'll be buying them next. That's how.
Let's take your word for it.
That's
Adidas,
how old they are.
Back to those lows from April the 5th or so. So there you go.
Oh, I don't believe it. What a waste of a trade idea. Right, are we getting any of the autos there? Oh, something's up 6. What's that, Danone?
Oh, yogurt, joy.
That's where you want to be. Porsche up 3.5%. We've got Kering strong as well.
Heidelberger up 15%. Wow.
The cement.
Yeah.
Wow.
Very solid move. LVMH up 0.8 on that story about France asking Trump to exempt champagne from tariffs.
Okay, good.
So there you go.
Have Gucci had numbers? Why are they up 3%? Ah, yes, they are, right. Gucci goods. No. Where are the actual numbers?
I haven't seen that this
There
morning.
we go. Net income 474. Gucci sales fall by 15%, but I think that's Kering's quarterly sales weaker than expected, but the stock's gone higher. It really shows you the difference between stocks that have underperformed and that are now relatively cheap.
Yeah.
Versus ones that have outperformed and expensive. I'm thinking British Aerospace, good numbers, stock down. Kering, bad to inline numbers. Yeah. And Porsche, bad to inline numbers, stock higher.
The joy of expectations, or the tyranny of expectations, if you're BAE and Rolls-Royce this morning.
Yeah. Right, time to let you go off and do your duties, all your social media posts.
I know, busy.
And we're going to get Tom Price in to talk about mining stocks, commodities, and what it's like to be Australian. We'll be back in 2.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Bring me the next shiny new thing. Bring me the next shiny new thing.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest, and it's days like this. We get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash. Welcome back, welcome back. I am very happy to have Tom Price in the building.
Thank you.
How are we doing, sir?
Oh, top of the world, thanks very much. Summer in London. It's hard to beat.
Isn't it? Is it?
Yeah.
No, what, yeah, is it winter in Australia just now, or
It
here?
doesn't matter. I'm in London, where it's sunny, sort of.
So, just to give you a bit of background, Tom and I worked together at Macquarie. He was the big boss, the head of commodities research.
Yeah.
And if you're head of commodities research at Macquarie, then
You're on a plane all the time, just talking to strangers. Yeah.
give us a little bit of an introduction to how you ended up in that position to start with. And
Just a series of bad decisions, thanks, Richard. So, but yeah, no, it's just the last bank I worked at, currently at Panmure Liberum, doing more or less the same thing, just powerful, deep, insightful commodity research.
Brilliant.
Yeah.
And then did you come from a mining background? Were you down there underground?
No, I did some underground time. I used to be a geologist, but my specialty was exploration geology. So I used to go out there and look for stuff. Yeah.
Right. And then that was back over in Oz?
Yeah, mainly in Australia, but spent some time in dodgy places like Central Asia, Russia, just looking for stuff there too. Yeah. I know, it's pretty exciting. Yeah.
Now, what what excites you about the sector?
Well, it's you have to be good at macro and thinking big, because the sector I looked at, global commodities, so base metals, precious metals, bulks and stuff, they just get tortured and tossed around by a casual throwaway statement by, I don't know, a US president. And so it really keeps you on your toes. You've got to be on it all the time.
And what's the key to understanding commodities as a whole, would you say?
I generally tell people you've got to know who the big buyers of a commodity are, or is in China's case, and who the big producers are. And every market, even though broadly they sit in the commodity space, they're all structured differently. And so you've got to understand what those structures are. Does it favour the producers? Does it favour the buyers of those commodities? And try to figure out which element of each market dominates price action. Right.
So demand supply, really working out where the imbalances are, oversupply. What would you put them into buckets at the moment, do you think? Or?
Well, there is some market. The bucket I would toss some of those markets into, if we're talking buckets here, is which commodities does China desperately need to keep the economy functioning?
Still that's what we were playing in 2007.
Well, it still matters. They consume 40 to 70% of all commodities supply, but there's some commodities they have no choice but to go overseas for. So, world's biggest aluminium producer, but they actually need to import most of their bauxite. Copper, 70 to 80% of their copper units are imported, and iron ore heavily dependent on imports, and particularly from beautiful country that I call Australia, Richard. So they're the three commodities.
You'd be in a bit of a mess without China buying your iron ore, wouldn't you?
We'd still be playing cricket and doing barbecues. It's not a big deal. And maybe playing rugby, for example, stuff like that.
Yeah. Now, which one would you like to go into first? If we're going to talk about copper, iron ore, the great and the good, you can see the comments here. So this is a live show. This is where we smash CNBC out the park.
I've never heard of that organisation.
Yeah, okay, some American outlet.
Okay.
And we can, get questions there and ask them straight to you.
Okay.
So
Go for it.
If we start with a couple of commodities you think are particularly interesting at the moment.
Well, I mentioned bauxite, copper and iron ore. Really, copper and iron ore dominate they're the dominant drivers of equities that most people are invested in. So think of big stocks like Rio, BHP, Anglos, Glencore, Vale. All of those have, including Vale, have iron ore and copper exposure. So most of the time I spend with clients, I'm always talking about those two markets.
Okay.
And so I think, that's probably where you need to focus on.
So that's us showing high-grade copper. Would you rather I get LME up, or is that a...
I've never... high-grade copper will do. The price action will be exactly the same. And crikey, that is going vertical. I wonder what's driving that one, Richard.
Yeah.
Probably a US price.
Almost as if somebody's interfering in the global dynamics.
That's a good word, interfering. It's amazing what a 50% tariff will do to a trade. And over the last 12 months, and it's not just the last few weeks since the US president decided to load up 50% tariffs, this market's been pricing a 50% tariff or something big for months, and we've actually seen a big transfer of copper into the US to try to close that arbitrage, and it hasn't really closed yet.
Taking it back to simple terms for basic Scottish people, like myself,
it's not true.
What does a tariff on copper mean?
Okay, so a president rolls out of bed and decides that tariffs are going to stimulate some sort of investment wave in the industrial base of his economy. So you can argue all day whether that's going to happen or not. I'm not convinced, and in fact, most people are not convinced. But he does it anyway. And first he talks about it, spends months talking about it, and then he actually imposes the tariff. What that does for the supply of copper within the United States is it lifts the entire supply curve up by 50% theoretically, or a large amount at least. Demand function hasn't moved, and so what that does is it delivers a big price lift to that commodity in the market. The US is in isolation with that decision, and the rest of the world looks at that and thinks, wow, I can actually deliver metal into that premium that he has just created.
Right.
The market in the US has priced in that extra cost, and people are shipping copper in to exploit that. That is step one.
Yeah.
The second step, which plays out over many months, is a steady deterioration in demand.
Yeah.
The demand function initially didn't move. No one's got any choice. They've got to pay that extra amount to get copper in the US. But over time, they start getting smart and thinking, okay, I think I've got to substitute away from copper, maybe try aluminium, reduce copper unit use, or just defer consumption. I'm going to wait. And we're going to see that play out, and that will ultimately drag on prices. So a price spike and then a fade. And that's a really important dynamic to understand if you're an equity investor with copper exposure, because you will initially benefit from the spike and then it'll fade.
And the spike's been about 25%? Or the spread has expanded by 25%?
Oh, yeah, that's right. The spread itself versus the LME is about 25%.
And so should that be 50%?
Well, no, because of the intersection between the supply and the demand function, so it gets mitigated. It also gets mitigated down the supply chain to the copper consumer. Everyone has to share that cost in the US over time. So that's how tariffs work on any good in the market. Right now, it's been levelled at copper, and also aluminium and steel. All these markets have been knocked about by this extraordinary policy, let's call it that.
So the demand function doesn't change for LME?
The demand in all countries around the world initially don't change. They just can't change fast enough. But over time, the rate at which it moves to the right, the natural growth rate, will slow. And in some cases, it may go to the left if we go into a recession scenario. We're not forecasting that, but tariffs do create that sort of risk that we need to think about from time to time.
Okay. And then what's kind of percentage when people talk about, right, you need a lot of copper for electric vehicles, for AI data centers. If I'm building a data center, is it a tiny cost so I don't really care?
It's the fact that you've asked the question that way tells me that's exactly right. Yeah, I mean, if you're building a giant building, some of the cost elements that make up that thing are trivial compared to the cost of the construction work. So a data center builder will be not entirely indifferent to copper, but it won't be a big factor.
Right.
Land access, government support and subsidies for the program of building it, so on, they're far more important. They probably spend more time on that. And also, can they control those cost elements? Probably not. And also the time frame, they probably build over 3 to 5 years, so they're not really concerned about what the copper price is doing right now.
Yeah. What's the smart trade then on copper at the moment?
Well, we're famously bears on copper in the market. Not many people can get away with doing meetings with clients with that view, but they are intrigued to see us. It's like catching up with a nut job in the street who's thinking about a downside risk to this market. In actual fact, bulls and bears have been completely wrong for 3 or 4 years, since lockdown actually, because the price has basically traded sideways.
That's it, yeah. Goldman this is the time, 2022, you got to buy copper now. You know, it's going to the moon.
Yeah, Goldman's some really powerful research there, mainly pushed by their desk, but they were talking about a super cycle thesis, which we thought was hilarious because it wasn't a super cycle. It was just a good old-fashioned inflation trade after lockdown.
Yeah.
But it's actually been trading at about $9,000 plus or minus 10% for the last 3 or 4 years, even though we've been bearish. And completely wrong, not surprising for a sell-side analyst. And the only thing that makes me sleep at night is the bulls are wrong too, because of that sideways trade. And it's possible it may carry on doing that. And that's one of the extraordinary things about the copper trade. There is a stunning amount of generalist capital that's been parked in the copper space, and so it tends to respond mainly to macro themes.
And then what about the mining stocks of the copper producers? Obviously, Anglo's, BHP tried to come and grab it.
Yep. So that was an interesting effort. 3 bids turned down. So and then Anglo's has proceeded to dismantle itself. And what it's trying to do is get rid of all of what it regards as non-core assets, perhaps. So coal, it's just spun off the Anglo-Platts division into Volterra. It's now considering De Beers. What's it trying to do? It's trying to be a copper-rich equity, which is regarded as very appealing to investors at the moment because it's a green input for greening the planet. So,
and are there copper assets really impressive, or there's big growth potential? Or
it's got growth and it's got high quality assets, but the superstar asset in the Anglo's stable is Quellaveco. So it's a huge South American operation. When we're looking at probably a 4 to 6 sort of level mine on planet Earth, and that's a company driver if they can, carry on developing that thing. So big copper assets takes staggering amounts of money, long lead times to get into the market, and they're doing a pretty good job.
Yeah. So. And now that they've cleaned everything up, if De Beers, they also managed to divest that. Is it just a bite-sized chunk for a BHP or Glencore or?
Yeah, it's only one company can clean up Anglo's, and that's probably Anglo's. And I've got to say they're doing a really good job. So, but eventually they're going to create an entity that will be enormously appealing for a major to engage. So, and the ones that investors keep sort of flagging to us. Is BHP, obviously, because they've already had a go at it.
Yeah.
Glencore, although it's just spent $7 billion on coal assets out of tech, so maybe it'll struggle.
But that was a reversal, wasn't it?
Yeah, that's right. Yeah. We hate coal. Actually, we love coal. Everyone.
Take my money.
Turns out we like cash. And poor Glencore's struggling with, very weak coal prices on met and thermal. It's the biggest exporter of both. So it's going to struggle, I think, for a bit longer. But Rio, Freeport, all of these are candidates for taking out a copper-rich sort of company like Anglo. So it'll be interesting to see that play out if it happens.
Yeah.
So.
Okay, let's move on to, let's take a couple of questions first to get them in. There was, have you any view on Greatland Resources, GGP? That's one that Andrew McKelvey.
I don't have any views on that.
It's more gold, isn't it?
Yeah.
And then we've got, let's move on to iron ore then.
Okay, iron ore. We can talk about gold too, see where Greatland's going to go. Iron ore. So what month is it? July. I start getting bearish about now. So I'm a seasonal junkie, as they say. I think about, seasonal drivers for this trade because the iron ore steel supply chain centred on China is profoundly seasonal. So what it does is China goes crazy bringing in raw materials for their steel industry, including iron ore, after Chinese New Year through to the centre of the year. And then about July, August, they start rationalising their production rate, start thinking about maintenance programs as they enter the winter period. And usually the turning point's about September, October. But this year we've got an exciting new bear theme to talk about, and that is China's government is actually considering capping production because they see a surplus in their local market, and so that of steel. Yeah. So China imports, as I said, 80% of their iron ore units, and so that's going to sort of retard the seaborne prices perhaps by fourth quarter.
Right. And then, so this leads into our beautiful drawing there that you've sketched so well. Let's see if that comes through on camera. No, not the chart, guys. We're going to hold that up. Yeah, brilliant. Yeah. There we go. So China's seasonality. And they come out of winter and Chinese New Year, and that period's a great transition for anyone who's invested in Rio, BHP, FMG, Vale. Anglo's also has the Minas Rio assets in Brazil. And this is what I call the blue water period, very quiet period between May and October. So we're in the middle of that. And then we go for the downswing. Now, China's government is acutely aware of this dynamic, mainly because they get our research. But I've spent a lot of time with Chinese mills and they talk about this. And this is a period where generally they try to clean up their capacity and tighten up their supply chains, and they basically draw down inventories. And that has a big negative impact on the iron ore trade. And generally, the best time to trade this is to basically buy iron ore exposure around November, or when Pameo Librum research comes out and tells you to, and then sell around here. So that's the trade there. Buy here, sell there. And we're right at the peak just now.
Yeah, we're in this period here, so downswing. And production caps will have a big impact. This industry is super lean and highly responsive to government policy. So when they're told to act, they do act. and that's something worth tracking. So the big iron ore producers are aware of this too. So
Yeah.
they get our research as well.
In terms of iron ore, Rios is obviously the king.
It is. It's the superstar producer.
Oh, sorry, and we've got the chart here, and you can see the cyclicality.
Yeah, make
the
up your own
cycles.
word. That's fine. Call it cycles. Save yourself.
There's certainly cycles there, isn't there?
Yeah, the transition to prices is not clean. It's quite messy, and the reason for that is the mills have amazing capability of switching between their different iron ore options. So they don't just get fines; they get lump and pellet, and they also pick up scrap, and that tends to neutralise the price response to the seasonal flows underneath. But every now and then they just can't help themselves, particularly if there's stimulus or some sort of positive outlook that is exogenous to China, and they will buy aggressively, and that will report through the price. But that's not that sort of year. They're very subdued, they're trying to manage their costs, and they're a bit nervous about this production cap that the government keeps talking about.
Okay. So, yeah, sorry, to go on to the stocks, that puts a bit of pressure on Rios, doesn't it?
Yeah, it does. So, and BHP and FMG in Australia, they're the main sources of iron ore for China. So, so China gets most of their ore from Australia and the extra bit from Vale, and they get nervous about this time of year. So, so this is, it was interesting. Their last quarterly update a couple of weeks ago. They did express surprise at how well China's economy has held up. They sort of praised China's ability to switch into the export trade because their domestic market wasn't strong, and to be able to manage the tariff war with the US. But they weren't bullish. I think they're expecting some more pressure to come on their trade, so they're a bit worried about that.
We've got a beautiful chart of Rios there. Down this morning because they reported soft numbers.
Yes.
Let's say, but I guess our traders are particularly they love trading Rios normally as a buy around these levels because it runs through that kind of support levels normally in those mid-40s.
Yeah, so I'm talking about fundamental drivers for iron ore and rather than the equities. But the equities have been under a huge amount of pressure all year because they're getting hit by the tariff theme. So investors are going, yeah, thanks for the seasonal charts, Tom, love the drawing, but I'm really worried that China's steel-bearing stuff to the world is just going to get taken out by this tariff conflict. So I'm just going to take some money out of the big equities and just wait. And so we've seen all of them come under a lot of pressure during the course of the year. So now we're starting to see some of the metrics get to some interesting levels. And we're getting calls from value investors that are saying, is this a good time to sort of get involved? And I said, okay, well, maybe just wait a couple of more months. So a better entry point's the end of the year, we think.
Yeah.
So.
Incredible. Right, so that's BHP, Rios, we've looked at Anglos, Antos. I guess we can't be bullish if we're bearish on copper.
Yeah, the most popular pure play equity with pure copper exposure. So Antos and Freeport. Freeport's just big, slow moving, and Antos is a bit more interesting. All their assets are most of their assets in Chile, and it's the exciting way to play the copper space. And they've been mining copper for decades. They are technically very competent, and they're very good at messaging the market. So it's if you want a nice, clean way to get exposure, that's the popular one to go for.
And have they still got the big family owners?
Yes. So it's still big, chunky family ownership that dates back 100 years. Started off in rail, ended up in copper, and they're not going anywhere fast.
Yeah.
So they're quite happy where they are, and I think we've got a hold on them at the moment, the stock. But yeah, it's hard to switch to a buy given that we're bears on copper. So we'll probably just hold that position for a bit longer.
Any stocks that you're particularly interested in at the moment or think are worth a look?
Well, I tend to look at the big stocks we've just been talking about because I'm a macro guy, and And decisions by the big mining companies obviously are very important to the main commodity flows. So,
Yeah.
but they're the ones that we sort of focus on at the moment.
Let's have a look at the commodities then. And yeah, so we've got platinum on the system. That's, you know, suddenly out of nowhere found some life.
Absolutely. So I've just been marketing in South Africa. So and we're bulls on PGMs. So we like platinum, palladium, rhodium. And we're also very confused bulls at the moment because the calls work, but for reasons we can't quite understand. So we would agree with you. It all happened, started to happen on Platinum Week in London, middle of May. So we were hanging out with PGM gurus, WPIC, the Oxford crowd, and also the Anglo-Plats mob, having lunch with them, drinking, laughing, saying, yeah, the price is going to lift. The price is lifting, you know, and over the next few days it started to lurch higher for no obvious reason. Looked through our network of contacts, didn't find anyone who was sort of restocking because that was the famous driver everyone was holding out for.
Right.
And in the last couple of months, it's bolted on 30 to 50% to very subdued price action that lasted for years on nothing in particular still. Yeah. And so we're still trying to come to terms with that.
I think it was because I sold my palladium.
That
was the final.
It's a
resistance
inventory poor market. So thanks for releasing that stuff. So what are you doing with the garage space now?
Yeah, it's shipping in, you know, whatever I can find.
I'm sure you'll do. Yeah, the cars. You've got to put the cars in there.
Yeah.
The catalyst, I think, was the Volterra spin-off. I'm convinced of that.
Didn't it? Yeah.
Because in the days after the spin-off, we were getting lots of incoming queries on the state of the PGM market, what PGM stood for. So obviously we're dealing with generalists when they're asking that question. What's PMG, Tom? No, it's PGM. And then you give...
What's Procter & Gamble got to do with it?
So there was a lot of 101 sort of chats for a few days from the US and here in the UK because the listing was on the LSE. So lots of intrigue, and I think people have basically positioned in an illiquid market, and that it wouldn't have taken much to actually make the prices pop, I think.
Right. So. And yeah, as you say, they'd been depressed for so long or capped.
Yeah,
I guess.
Yeah, thoroughly capped, and but the fundamentals of this trade are extraordinarily tight. No one invests in new supply. Most of the supply comes from essentially two deposits, Norilsk, which we're big question mark over whether we can access that supply. We're still getting Russian PGMs, but you know, who knows what would happen in the future. And the Mariinsky Reef in South Africa, and no one's really growing supply for one reason or another.
Yeah.
And it turns out we actually need internal combustion engines with autocats for a bit longer, maybe a few more decades, and EVs aren't going to save us. And so demands hasn't really changed a great deal. So that's a winning combination for price upside.
Yeah.
But the prices haven't responded to that until May, and now we've got a very interesting market in play.
Right, so that's gold. Yeah, we mentioned we were going to have a look at gold.
Gold, yes. So extraordinary price lift over the last 12 to 18 months. It's now sitting comfortably at about 3,300 and holding. So it's actually been range trading. There we go. You can see the range there since the end of Q1. Very tight range. I think it's 3,300 plus or minus 3%. And what that's telling me is all the bull factors are thoroughly priced in and understood by the market.
Right.
What are those bull factors? Most of them are short-term drivers. So we've got a rate cut cycle theoretically still in play. We're going to find out whether it is or not this week.
This evening, yeah.
This evening. But the other factors include deterioration in global trade. That was actually happening since Russia invaded Ukraine. So a lot of confusion and uncertainty between major players around the world.
Yeah.
And then that's been compounded by the fact that Trump's rolling out tariffs, so there's a lot of uncertainty there, and so people buy more gold. But you've got war themes, so we keep seeing it pop up on major incursions or events. So Israel versus everyone in the Middle East, Russia versus Ukraine, China's Taiwan confrontation, Cambodia, Thailand. Oh my God, it's just lots of themes there. Buy more gold. But the one driver that I think is enduring and extremely bullish and difficult to quantify is China's willingness to keep buying metal from abroad and storing it in a back room somewhere. And I think they have, it's quite clear to me anyway, that they've got a plan to back the renminbi and perhaps offer a reserve currency to the world. And they need to back it with gold. And so that's a theme that's probably worth tracking. So the World Gold Council tracks the reserve positions of all the countries. And I think China's number 6 now, with about 2,500 tonnes of gold, versus the US number 1 at 8,000. So they want to go big in gold. And so if you're a gold bug, that's a very exciting theme.
And that is, that's the longest of long-term plans, I guess, because how...
No one does long-term plans better than the Chinese, and that's decades long, I think. So maybe we should get comfortable with a higher gold price than what we're forecasting. So that's probably the biggest upside risk to our forecast at the moment.
Great. Smaller ones like aluminium, nickel.
So the Ali trade was knocked about last year by supply chain themes. So we had multiple refinery failures in Australia, or closures. So Alcoa had some Western Australian assets. One of them was shut down for cost reasons. And Rio, in their Queensland asset refinery there, they had power issues. So we saw about a couple of % of global alumina, that's the oxide used as a feedstock for aluminium smelters, shut down. But the real driver was Guinea, sourced at 25% of the world's bauxite, the raw material that gets converted into oxide and then to aluminium. They just randomly decided to shut down exports, and that starved the market of another couple of %. So my modelling went massively into deficit, and the entire supply chain, bauxite, alumina and aluminium prices all lifted. It's all calmed down a little bit this year. So we're seeing the bauxite and alumina prices stabilise, but now the aluminium price has been knocked about by these tariff themes. So, it's a very exciting time to cover that space. So, but in terms of equity thoughts, Alcoa, Rio Tinto is a big producer, Rusal, if you can trade in Russian stuff, and Chalco in Asia. So they've all been beneficiaries of these various and evolving drivers for aluminium. So think of a price of about 2,500 to 2,800. That's the range the aluminium price is going to hold in.
Now, before we let you go back to the real world, if we get a scenario where there is peace, Russia and Ukraine, and gradually, backed by Trump, Russia's allowed to become part of commodity world again, what are the kind of smart things to look at?
That's a good question. So the popular view is energy markets will collapse because you get this flood of coal, oil and gas. So pre-war, Russia was the source of 10 to 15% of all those three commodities. And so production would be cranked up because they're connected back into the world and we'd be overwhelmed with it. Not true. In actual fact, the supply rate of Russian coal, oil and gas to the world hasn't really changed a great deal. In fact, for coal and oil, it lifted and went into their dark fleets. Gas is probably the only one that was truly constrained because the infrastructure pipeline into Europe couldn't be switched physically anywhere else, and they couldn't really crank up their LNG capacity. So maybe we'll see a resurgence there, but the EU is quite determined to shut down pipeline forever. They're talking among themselves and they're trying to terminate it forever in 2027. So maybe the lack of Russian gas will keep gas prices across the world through the LNG trade higher for longer. So that's the one we're probably thinking will be the bull case. All the metals trades, copper, PGMs, they have constantly been delivered into, and aluminium, they've been constantly delivered into the world ever since the war started. It's never really been effectively shut down. So I don't think that's going to change much either. So the answer to your question is not a big change, perhaps a little bit of bullishness around gas.
Excellent. Tom, thank you as always.
Thank you very much.
I very much owe you one of our dinners now with our good friends Yanis and
Alan and
Grant.
I saw Grant yesterday.
Oh, good. Thanks for the invite.
Yeah.
Good stuff. Tom Price, thank you very much from Panmure Liberum. And yeah, stay tuned for Charting Crypto with Chris Beecham coming up right now.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest. And it's days like this, we get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account.
Good morning and welcome to Charting Crypto with me, Chris Beecham. Let's have a look at what's been going on in crypto prices this week. Starting with Bitcoin, trading essentially where it has done for the best part of 2 weeks. So what we've seen here, and I think we touched on this briefly last week in our Wi-Fi trouble plague session, which we've now sorted, a sideways price movement. In fact, this is a theme from Monday's session as well. No, thanks to the excellent technical staff here. They really are brilliant. It has... Markets go up, they go down, but they also go sideways. And it's exactly what you're seeing with the crypto prices here. You've had crypto week in the US. You've had all the excitement of the regulation to encourage the use of Bitcoin. You've had institutional flows, which are still continuing. They reached about 4.5 billion over the course of crypto week. Ethereum, notably, which we'll come to in a minute, actually beating out Bitcoin with 2.4 billion of that. But really, it looks like, obviously, the regulatory environment in the US is far more conducive to crypto. Adoption is expanding. But a lot of that news is, as you so often hear with markets, in the price. What does that mean? That we already had the rally at the back end of June. We went from 100,000 in crypto to 120,000 in Bitcoin, very much in a very short space of time, over 2 or 3 weeks. The good news is factored in for the time being, and you have to allow time for a price to digest this news, and that's exactly what you're seeing in crude prices right now. But often markets correct in time rather than price, which is a fancy way of saying it doesn't go down, it just goes sideways. And this is exactly what you've got in crypto prices right now. You've had obviously that peak from the 14th of July at 123,000. We just haven't been able to hold on to those gains, but nor really have we been able to sustain any notable move to the downside, which was, as we saw the case on Friday. We touched, a 3-week low in crypto in Bitcoin prices, and then lo and behold, the dip was bought. But it hasn't had enough yet just to push the price through 120. It's exactly the story we had last week. 120,100 is just roughly the level we're looking at in crypto prices, in Bitcoin prices, for the moment, with no break to the upside for the time being. But it is a rising market. We're still looking, arguably, it seems more likely that the upside will reassert itself than we get more of an extended move to the downside. Stochastic indicators, I just like this one because it gives us quite a decent set of entry points. It's worked out nicely. You've had, again, a crossover here. Bullish crossover tends to argue for a resumption of the move to the upside. Momentum has come off significantly. And it's interesting that, as no doubt Axel will point out, you had the surge here even as momentum continued to weaken. So we'll wait to see whether that starts to reverse itself in the short term. Maybe you get another return to push towards 123, but that's exactly what we're looking at in Bitcoin at the moment. Our floor is around 116, maybe down towards 114,800 and 114,900 really. That's our line in the sand for the time being. And as you're looking back, of course, to that May 22nd high at 112,000 is your next potential support level. Yes, we've drawn a trend line. I find myself drawing trend lines less and less these days because I think it almost gives you a false illusion of security, but it should help to clarify your thinking. And that's what we've got here, is obviously the uptrend in Bitcoin prices, which seems set to continue, but maybe they have this consolidation. Those of you trading gold will know how tough consolidations can be, because that's exactly what we've got, and they can go on for quite some time before it resolves into another move high. So just be prepared for that volatility for the time being in Bitcoin. Moving on to Ethereum, of no consolidation here, really, or at least it hasn't yet started. Momentum still remains very, very strong, but here, and I'm going to channel Axel, even though he's not, I say he's not with us, he's on holiday, that's what I mean. You've got this negative divergence. What do we mean by that? You've got the price making a higher high, but the stochastic momentum.
A reaction high is simply a high which is higher.
There's the voice we were expecting, the voice of God, or Axel. In technical analysis, it's mostly the same thing. You've put me off my flow now, gallery. Yes, you've got new higher high in the price, but a lower high in momentum. You can do this with stochastic, you can do this with RSI, you can do it with MACD. It's just maybe a sign here, crucially, because as we know, there's no sure thing in markets, that this rally might be due pullback, consolidation. Either is a possibility, but it's a sign of waning momentum. So just be cautious of that one. And I say maybe. It isn't always the case. There are enough instances of negative divergence, indeed even positive divergence, that don't work out. That you just have to, that's what stop losses are for, that's what your risk management is for. So that if you're not correct on that, you're not unduly affected by it. But it's just one to bear in mind here, that you've had the price making the higher high, even as momentum has shifted to the downside for the time being. Still in overbought territory, as Bloomberg and others would love us to point out. That simply means overbought is code for gone up a lot, but it does show you that usually overbought markets beget more strength to the upside. So if it drops back below this 811 stochastics, it's usually a sign maybe that we do have some movement to the downside. It's kind of what we had from the middle of May into late June. I surge here, and then as momentum weakened, the price just couldn't sustain itself, and eventually you had this durable low formed at 2,200. But as we say, Ethereum, the big beneficiary of those inflows in crypto week, still seems to be a lot more popular. Unsurprisingly, I think what we're seeing with Bitcoin and Ethereum is a bit like gold and silver. Ethereum's the cheaper one. It's bound to attract a lot of attention simply because the price is lower. There's no art to it. There's no magic to it. It's just what we're seeing at this point in time. But still a very, very strong move after this kind of surge to go from 2,200 to 3,800 in a very, very short space of time, really, considering where we've come from. It should therefore be followed up by consolidation. Trees don't grow to the sky, a phrase I find myself using more and more with respect to Nvidia and others. But after this sideways movement and this surge to the upside, you're just waiting to see where we go from here. So consolidation would not surprise me for the time being. And then let's go on to Solana. A bit more interesting. It's really interesting to see the sort of divergences, crypto behaving in different ways. You can't simply lump them all together in the same way that with indices you do get this movement. So that does provide the variety. Don't forget, of course, if you're looking at it, to keep your overall risk exposure to crypto within manageable limits. But here you are, similar to Ethereum, of course, the surge from 130 to almost 210 by late July. A bit more of a substantial pullback here, which is kind of what you want to see, I think, as a bull. We were talking about this in the show earlier with equity markets. A market that goes in one direction tends to make me nervous as a bull, particularly, and I think this may be what you have here with Ethereum. If you get, perhaps watching this stochastic, or indeed of course watching the price is the most important thing, if it can get above, close above 190, there's your more sustained indication that maybe we do have a bit of a move higher. But yeah, as Doug is saying, why is Ethereum so strong at the moment? Just primarily it is that institutional flow. The element is there, the BlackRock element is there to it. Institutions becoming more and more involved with crypto, which of course adoption viewed as a good thing by the crypto community. But here we are, crypto prices for Solana just coming back down again. We're just back below these May highs, so a little bit more consolidation would not surprise us at this point. And then if you're looking further on, 168, that early June high. Below that, you've got some interesting support maybe developing around 160, because that was support on the 20th of May. Yeah, there we go. And back further in history, the 18th of Feb. So another key area. You can see as well how when we've been crossing 160 either way, it's produced some reaction. So watch for that one if this sell-off begins to materialize. But certainly, again, less of a definite uptrend here for Solana. It's taken certainly more, the longer we zoom out, the more it shows that we've actually had a bit of a weakening of momentum, certainly over the course of the past year. But so not quite the euphoria you're seeing with Bitcoin and Ethereum. Thank you very much, everyone, for joining us for a perfect lack of problems with Wi-Fi. Don't forget to like and subscribe, and we will see you again next week.
In the last video, we talked about how the S&P 500 has a higher PE ratio than the FTSE 100 because investors expect faster earnings growth. But do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
We're watching a crisis unfold in the UK, and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle.
Let's get those all sessions underway, people. What have we got this morning? Well, we have Visa looking down 2% from the off. That is Visa, as in how we all pay our bills, looking down 2%. But PayPal up 1.2. We've got Moderna also decent there. Eli Lilly continuing to bounce a little bit back from yesterday, but look at it. It was trading at 810 when that Novo Nordisk warning came out yesterday. Eli Lilly from 810 down to 760. United Health, oh, I know a few of you have been involved in that one. Did not have a good day yesterday. So United Health, let's take a look at that one actually. On the charts and see, oh dear, what a horrible day. Yeah, we saw the move. That's gone crazy. That's the daily. But yeah, finally blowing down under the support levels at 280 down to 262. I don't know where that goes now, guys. That is, I know that's been a really tough one. And I know producer Phil tells me that there are some bulls still out there in the Discord chat as well. But this is the day. That's a tricky one because you never really got a chance. If you're in the stock there at 275, then everything's looking good. And then, you know, you just have that horrible sinking into the close. That's between 7 p.m. and 9 p.m. So we've got that one, but a little bit of a bounce so far today on the open. What else have we got? McDonald, I hear you say, tell us some good news. Well, the good news, if you are a NVIDIA holder, then they're up 70 basis points. You got Boeing continuing on 227. Intel, it's a bit soggy again yesterday. Struggled to really do much, but there wasn't any rally. Uber had a particularly bad day. Lost a court case in London around tax, so it is going to have to pay tax to the black cabbies, I think. That's 87.5. And then, yeah, much of muchness. Amazon ahead of reporting tomorrow, up 25 basis points, and Tesla up 25. So we got, yeah, Visa is the main negative. Nike, we said to you yesterday, JP Morgan Research was telling you that the World Cup was coming next year, which I think a few of us knew already. So that 4%, Nike gave back 1.5 yesterday, giving back another 60 bips tomorrow. It feels fully valued at $78 at the moment. If it gets up to 79 again, then I will be selling some calls for the short term. Right, let's see if we've got any questions on the chat there. Monkey Man looking to get into UNH around 250. I thought there would be some interest in this thing because we did speak about it for a while, a couple of months ago, didn't we? We expected, I think we looked at a options trade actually, and that options trade was for it to go back above 300. It did, but it didn't stay there for long. My goodness, it didn't. There it is. So back up to 320, and then just this whole month of selling. So Monkey Man, yep, 250. makes sense. I know there's a lot of bulls out there. And right, we have a quick look back at well, actually, sorry. First of all, we do the second tier names. Let's see how they're getting on. Peloton up 6%. Lyft also on the way higher, up 3. Plug Power up 2. Has given some back. We got Piers on the show tomorrow morning. I have the pleasure of Piers staying in my spare room this evening. It's the only way we could get him on the show tomorrow morning was for him to have somewhere to stay in London. So him and I going out for a steak dinner tonight at 6 p.m. And then we're going to watch the Federal Reserve at 7:30, the press conference. And then we're going to watch the results from Meta and Microsoft at 9. What a cracking evening. So, yeah, Piers and I will update you on our steak dinner tomorrow evening. Tomorrow morning. Right, what else? Where's our losers on the second tier? Well, it's Novo Nordisk, down 3 again. Novos, if we can get those prices up, down 3 to 52.30. That's on the back of those downgrades. Then we got Palantir unchanged, 007, James Bond, 156.45. Right, now, producer Phil is saying to me, don't forget to... we got a question. Right, Trump's deal with the EU, does it have to go to a vote within the EU? And what will the countries say or do? Well, I don't know what the answer is, because there's been so... the negative comments from some of the leaders have been absolutely incredible. But I'm not sure that it actually has to go to a vote. They're going to be in trouble if it has to go to a vote, because some of these negative repercussions for Germany, for Italy, are particularly poor. So let's see. Also on the Discord, I think that was from the Discord, producer Phil is going to be working on the portfolio challenge today, he tells me, and yeah, we'll get more on that. And then finally, I'm also told Andrew McKelvey particularly, bit of a crap day yesterday, so our hearts go out to you, sir. Hopefully today is better. And yeah, if you want to join the Discord group, please, producer Phil is going to put the name up there of Maturin's Discord handle, and you just add that and you can get into the club there if you're not in already. Also, give us a like and subscribe on the chat. We've got 1,340 people now, so we're getting up there. Good stuff. Right, but one final look at the UK movers for Expo now, down 6.5%. HSBC getting worse. HSBC down 4.5%. BAE Systems giving up some of its fantastic performance over the past 18 months, down 3%. And yeah, so really soggy reporting today, with Rio's also down 1.6%. And yeah, we got on the upside, of course, we have Glaxo. Also, Glencore up 1.5%, back up to 310. You heard here, that is the second mining expert that we have had in that has said, Anglo American, keep an eye on it. Once it's all tidied up, give it another, whether it's 6 months, whether it's a year, and it will have made itself into a beautiful asset that is very much bite size for one of the big majors. So that's an interesting one there. Okay, time to move on to our podcasts. This is the second episode, so you can watch the second episode. If you like it, you can also go on to the third one, which is on the IG.com YouTube. So not the YouTube that you're currently on, but the IG.com one. And this episode is explaining the basics of equities. Right now, if you're watching the show, you might already know a bit about equities. So, feel free to watch this, see what Spice thinks, but also episode 3 available on the YouTube, on Spotify, and on Apple Podcast as well. And episode 3 is all about bonds. So that is a really, really good knowledge drop there from Chris Fellingham, who has worked with George Soros and worked with a lot of the big bond funds around the UK. Thanks for joining today. It's been a pleasure. Angeline off sunning herself somewhere. But we'll see you again tomorrow morning. Look forward to it, because tonight, the Federal Reserve, Meta and Microsoft, what is going to await us tomorrow morning when we come in? Join us to find out. We'll see you tomorrow. My share price is higher, though. I've got a lot more future earnings potential.
Yeah. God, I'm really worried about losing money. I'm not going to buy any financial assets.
The whole of Scotland just switched off.
Joking. I was having a bit of fun with you.
So you're getting a yellow card straight away. Now, talk about not getting markets right.
Why are you looking at me? Why are you looking at me?
I'm glad it to you, not me.
Wow.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome back to The Art of Investing, a new podcast all about helping you achieve your investing goals. Brought to you by IG, the global investing platform, a FTSE 250 company with over 50 years in the markets and here to champion the investor. If you're new to investing or you've been doing it for some time already, you're in the right place. I'm Rich McDonald, and every Friday I'll be joined by my co-hosts Mark Spice Holden and Chris CJ Fellingham to turn market chaos into investing clarity. So, first of all, I'm going to go to Spice. Please introduce CJ.
Well, that makes a change because he's more senior than I am. So normally I'm coming on second. But joking aside, he's way too modest to ever say much about himself. But he is the best, one of the best all-round investors I've ever worked with. And so that's enough of blowing smoke his way. But he's also a world leader in government bonds. He instinctively understands risk, which is a really key part of running any sort of portfolio. And he's worked at the highest level in some of the biggest and best investment firms around the world. The fact that he's always been more senior to me probably explains why he looks more stressed than I do.
Very good.
And certainly why he has less hair than I do.
Over to you. Tough to beat.
Gosh, how on earth does one follow that? I mean, what a great write-up. I wish I had such great things to say, but unfortunately, I've got to be realistic. No, on the real side, Mark and I have known each other for about 40 years. Mark's worked on both sides of the fence. He's worked on the buy side and the sell side. And the great thing about Mark is Mark tells a great story. And therefore, he can do both extremely well, as we will find from this podcast. He's a trend follower. He's a momentum investor. He likes the markets when they're moving in a way with an impulse. He likes to get on that and follow that. But he's very good at getting off quickly when the market turns around. He loves rugby, equities and commodities.
Now, as you can already tell, these two can talk. And nowadays, Gen Z attention spans are about as short as you two's memories will be in a few years' time. So to combat that, we have a yellow card, which we have yet to get quite to the bottom of what the punishment will be. So I want to hear from you, the listeners. What should the punishment be for a red card? If these two ramble on too much, write to us, theartofinvesting@ig.com. So a reminder why this podcast is different from all the others. We're going to be launching a model portfolio, which you can follow at home. And you're going to find out that these guys, the Warren Buffett and the George Soros of the UK, how they construct that portfolio and then how they manage it over time. So today we're going to be talking about what do you have to think about beforehand when constructing that kind of portfolio. And then over the coming weeks, we're going to take a deep dive into the asset classes. And today, Spice is going to bring you equities. So without further ado, it has been quite the week. Mark, what's been happening?
Well, as you say, it's been a pretty hectic week. Underlying that is because if you looked at the top level, actually markets haven't changed a great deal this week. We're sort of bumping just below all-time highs, which is great. There's consolidation at these higher levels, which is good. But we are just starting the second quarter or interim reporting season, which for equity investors is very, very important. And it really started with a vengeance this week. It picks up in the next couple of weeks. So this week we've had big results from companies like ASML, which is the company that makes machines, that make chips, that goes into the AI boom that we're all hearing about. But they had a bit of a profit warning. Their shares were down about 9% yesterday. And Renault had a similar sort of bad day where they were down about 15%.
That's the French car maker.
Exactly. And, both of them pointed to the fact that they're uncertain about what's going to happen in next year in 2026. And so analysts being analysts sort of take that as meaning if they're uncertain, just to nudge the numbers down a bit. And that's in fact what the management want to do as well. They want to get the numbers down a bit and then hopefully beat it later. And you'll find that happens with equity guys.
But isn't that the same as always? I mean, I'm, as you know, a bond guy, so I don't know a lot about equities. But whenever I look at equities, I see that the management talk down expectations one week, beat it marginally the next week, and the same story goes on the whole time and the stock market goes up. So isn't this just normal preparation?
Oh, totally. It is an art. This is one of the arty bits of sort of investing. And I was going to talk about it in equities anyway, but management, the good management teams will make sure that they can always beat analysts' expectations. In the run up to them actually announcing it, they've normally noted their numbers down, sometimes by 4 or 5%. So they actually, on the day they report them, beat them.
And of course, who's going to be better than that than investment banks? So funnily enough, JP Morgan managed to beat numbers. Bank of America managed to beat numbers because they manage expectations very well. It's a little bit, like when I go out on a date. I don't want to build myself up to be more special than I am. And companies do the same, don't they? They set a level of what their expected profits are going to be, but still with the thought in mind that they'll be able to beat it on the day.
Absolutely. And the interesting thing, as you mentioned, the banks, they've had a great year so far, mainly because Trump is bringing in deregulation of some of the financial markets, allowing them to have more capital that they can use to grow their business, give back to shareholders, whatever they choose to do. So pretty much all the banks we've had report so far this week, Citibank, Bank of America, as you say, Goldman Sachs, Morgan Stanley, all beat expectations. Interestingly, the shares moved very little, actually.
CJ, what has been happening in the bond market then? Because you've seen a move at the long end. Now, you introduced us to what the long end is last week, but what has happened with this Jerome Powell story?
I think there's two stories this week. First one was CPI numbers coming. So that's inflation. So when we look at inflation in financial markets, it's called CPI, consumer price inflation. And inflation numbers generally have come in, on the high side, either at expectations or above expectations, if we talk about the UK and in the US. So that's made people think about, well, maybe interest rates aren't going to be cut as quickly as they would otherwise be. That's led to, certainly in the UK, 30-year bond yields back up towards 5.5% again. At the end of the day, though, in the States, we're back up at 5% at 30 years. And we're at that sort of, are they going to rise a lot from here or not? Are they going to hold here? If they hold here, equities are fine. But if they start to rise from here, they might undermine equities. Now, to your point, out of course comes Trump yesterday with one of his classic Trump moments. Has an interview. He says, well, I've seen the documents getting rid of Jerome Powell, the chairman of the Federal Reserve. Clearly, an extremely important person as far as the US monetary policy is concerned. Markets suddenly turn tail, run down, equities fall 0.5 to 1%. Uncertainty everywhere. Dollar sells off. And then he comes out and he says, well, effectively, he says, joking. I was having a bit of fun with you. And back it goes. So net, nothing happened in that sense. But it just shows that the political risk in the States continues to be high when the person in charge feels that markets are there to have a bit of fun.
And we're going to talk about risk in a lot more detail in a few minutes' time. But I thought this problem of inflation, I thought that was a post-pandemic thing. 2022 inflation, we all know what happened. I thought it was gone. I thought it was solved.
Well, it had been trending back towards the level central banks want it to be, which is about 2%. But, the Europeans want it at 2%, we want it at 2%, the Americans want it at 2%. And we're trading back to that. So the UK is coming in at about 3.6. So the CPI data, the inflation data should look a little bit better. But mixed into all of that is what's happening with tariffs. And we don't really know still what impact that's going to have and how many companies are going to put those tariff increases through in terms of prices that go through to the consumer. That will be key. That will be what drives the next wave of the CPI inflation data and ultimately interest rates.
But there's worries around the central bank. There's worries around inflation. There's worries around the Middle East.
Return back to what we said last week. Bull equity markets climb the wall of worry. So while there's things to worry about, there's people sitting on the sidelines with cash, wondering whether they should be investing it. So the markets continue to remain bid and push upwards. The time to worry is when there's nothing really to worry about and everybody thinks things are relaxed.
Euphoria.
And that's when you have to be careful. But we're not there yet. We're going to be obviously talking more about those subjects in the next few weeks. But at the moment, there's still room to the upside. There's one asset class which we haven't spoken about yet, which I think is going to be important for us for our portfolio construction, which is, and I'm not sure whether I dare say it, but cryptocurrencies and Bitcoin. Last week, Bitcoin had a tremendous run. Actually, Ethereum, which is another cryptocurrency, perhaps the second most famous one, did even better. It was up about 30% last week against Bitcoin up about 8 or 9%. The reason is that this week is called Crypto Week in the States, where there are three acts going before or three bills rather going before the Congress, and they're all supportive of the crypto markets. And so people have thought, well, this is coming through. It's not just theory; it's going to happen. They're going to become an investable asset class. People are getting more and more excited about it. The bulls are back in. The hype is starting. And some of these things are doing very well indeed at the moment. So we'll be tackling that 2 or 3 episodes more in. We'll be talking about cryptocurrency where maybe that should appear in your portfolio construction. But it's important to see how well they've done.
You two you're both very bullish on every asset class. So you're getting a yellow card straight away because we are meant to be down the middle. We're meant to be open-minded. And all I'm hearing is new highs, supportive to assets. What about good old-fashioned cash?
But you're not listening carefully enough because actually, when we get to bonds, which will be next week, we're both probably pretty bearish of bonds because we think bond yields have to go higher with the way that governments are borrowing more money. I'll be explaining all this, how it works next week. But if you remember from our first episode, government bonds is the difference between how much a government buys and how much it sells is what they raise in the bond market. And we just think governments are going to spend lots and lots and lots of money and they're not getting so much money in, and therefore there'll be a rubber meeting the road moment.
Interestingly, NVIDIA, the world's biggest company, hit a market capitalization of $4 trillion, which is the first time any company has ever done that last week. And to give you some perspective again on NVIDIA, this is the world's leading AI chip maker. Mm-hmm. And it wasn't that long ago that people were worried that they were never going to be able to sell any chips to China. This week, guess what? Trump and co turn around and say, actually, you can sell your H2O chip to China again. The share price popped up another, popped up another sort of 7 or 8%, and is now up 100% from where it was on April the 7th, when it had just fallen 30% after the Liberation Day sort of
3 months,
speeches.
It's doubled.
It's doubled, and it's the world's biggest company.
And when we talk about it doubling, it's added $2 trillion of market cap. Give us an idea. Nobody knows what a trillion is, right? It's, 100th of a quadrillion. Put that into perspective with a UK stock market or a European stock market. What is $4 trillion of market cap?
Okay, so to give you that perspective, the UK's biggest company is AstraZeneca, and they are $0.22 trillion of market capitalization. So NVIDIA is 18, 19 times bigger, okay, on its own. And to give you even more eye-watering facts, what is really scary is that NVIDIA on its own is 30% bigger than the entire UK stock market put together.
30% bigger.
One company, and it's 30% bigger. If you're a professional investor, if you don't get NVIDIA right, you ain't going to get the markets right.
Now, talk about not getting markets right. There is... no, not that. That wasn't my
Why are you looking at me? Why are you looking at me?
I'm glad he looked to you, not me.
Wow.
So it's so important to emphasize here. We're talking about long-term investing, right? We're not talking about trading. We're talking about setting up a portfolio that is going to perform over the long term, over a number of years. And you've given the number of 10%, right? And that's going to be the sort of benchmark that we're looking for. Now, anybody can say, oh, I've made 10% in a week in Bitcoin. But we're talking about pensions, about ISAs, and what considerations do you have to take in when, over the next few weeks, we look to construct that portfolio and then launch it?
Some great commentary and comments there, Richard. At the end of the day, portfolio construction isn't about just buying one company, holding it and going, look how brilliantly I've done, except if it goes badly, when look how badly I've done. Portfolio construction is much more of a difficult science. And there's many things to think about with portfolio construction. And as you say, our intention is in a couple of weeks' time to form our portfolio, having talked about the asset classes, and then people will see how we think about some of these things and put it all together. But what I wanted to talk about today in particular is risk and how people think about risk. There are many, many, many different ways of thinking about risk, but they really drop into two categories. The first category is loss aversion. The big sigh from you there, Rich. Obviously, this is one that's got a lot of sympathy with you.
The whole of Scotland just switched off.
Yeah. It's really interesting how we, as society, have made this the big definition of risk. What do I mean by that? If I go to see a wealth manager, one of the things they ask, how would you react if the market fell 20% over the next 3 months? And they're always negative. And they're trying to gauge what your risk appetite is. Okay. They are doing that to protect themselves from the regulator who is saying, you must know your client before you can do anything for them. And the way they do that is by understanding what your attitude to losing money is. And that's what they're defining as risk.
And I guess this is what Rachel Reeves was touching on this week, is that the regulations around wealth managers, around banks, we've built it up so much over the last 15 years that it's now holding people back from taking risk.
Well, as I said earlier, she'd obviously listened to our podcast last week and finally decided to follow the trend here. And that is, she's saying we are too risk averse and therefore we need to think about it in another way. Now, the way I like to think about risk, so that's one way of thinking about it. The way I like to think about risk is your risk against your liabilities in the future.
Like Spice's boat and there's the big holidays.
So Spice says, I want a big boat and I want a great holiday. How am I going to get there? He therefore has a plan of what he needs to get in terms of returns to get there. So we need to think about risk in terms of against that liability. So against what we're hoping and aspire to in the future, what's the biggest risk you can take?
Well, that's a complete different concept. I've never looked at that. So when I get to your guys' age, then I already have to know what my living expenses will be roughly.
You've got to think about what you will need and how are you going to get from this size to that size. So the biggest risk, you very cleverly changed the topic there when I asked what the biggest risk is. The biggest risk is cash. Because we proved in last week's episode that when you look at returns on cash after inflation, it's negative. Bond markets, equity markets, over the long term, after inflation, give you positive returns. So if you sit there holding a lot of cash, you're actually losing purchasing power for the money in the future that you're going to have. So the first thing to remember from the way I look at it, therefore, in this basis is, whilst cash might be something you want 6 months cash to make sure you can pay your bills or whatever, when you're looking at your investment portfolio, what you need to think of is, what financial assets do I need to be in? Because we know those financial assets will, over the long term, beat cash.
The only time cash works properly as an investment that actually makes you good relative money is when you've got deflation, not inflation. And that actually is something that all central banks fear and will do everything they can to avoid, as we saw during the credit crunch, the great financial crisis. When prices start going down, the only safe place to be is something either like gold, but more importantly, cash.
Right.
Because it can't fall in value. It may not go up in value, but it can't fall in value. And when interest rates, as they did during the financial crisis, go negative, and you have to start paying the Bundesbank or the German banks, the central bank, to hold your cash for you, why would you do it? It's madness. Yeah. But if you think and historically we've only had very few bouts of deflation, so there's been very little need to have cash. Over the longer term, inflation has averaged 3%. Mm-hmm. And if you own cash, you will make no money on that. It's a zero-sum game, effectively, against cash.
Because that's about the average interest rate as well.
Exactly.
So you get nothing. The other end of the argument, I'm worried about US stock markets at the moment. I think that they are potentially fully valued. I think a lot of people, when they hear the word portfolio, that means 8 stocks or, 12 stocks or a few ETFs. You're not saying that you've got to be fully invested into stocks, individual names or whatever. There are a number of assets that are available with varying levels of risk.
So that's why I attempted to choose my words carefully and talk about financial assets. So there are lots of different financial assets, ranging from government bonds, corporate bonds, private equity, public equity, commodities, cryptocurrency. All these things are all asset categories.
But is there a podcast where I can find out about each individual asset class?
There, funnily enough, happens to be one that has just started last week, and we are intending over the next few weeks to cover each of these asset categories for the following reason. If you accept my argument that cash is a highly risky strategy against your expectations for the future, your liabilities in the future, and you want a financial asset portfolio, what it makes sense to do is to build a financial asset portfolio of, and I'm going to put it in inverted commas, cheap assets. You will hold those assets, and over time, some will go expensive. And when they go expensive, you then say, I'll take some out of that bit of the pot and put them in something that's cheap, on the basis that financial assets over time will beat cash and give you that good return. So what we want to do over the next few weeks is to talk about the asset classes, talk about whether we think they're cheap or expensive, which comes to your point about what you think about the US equity market.
And also the two of you have slightly different preferences there.
We have. I am much more of a fan of the European equity markets. They're not nearly so expensive as a rule. Mark is much more of a fan of the US market and the exceptionalism. And there's a lot of good reasons to have that. But we will be talking later about how you look at equities, and then we can decide what's expensive and what's not when it comes to our portfolio construction meetings in a couple of weeks' time.
And the great thing, we are going to be having the live debates on here, whether to move some of our assets from US markets into the FTSE, whether to move some from the FTSE into gold, whether to have a bit of oil. We're going to cover everything, and we are not going to agree at all times.
No,
and bonds and cash. The cash will have a place if we think things are expensive. But you just need to remember, if you hold cash for a long time, chances are markets are going to go up, and that's cost you money. And that's the big problem for people. Almost everybody holds too much cash, and therefore they miss out on these excellent returns in other asset categories.
I'd like to take a moment to make you aware of an awesome offer IG is currently running. Until the 15th of August, IG is giving away a free UK share bundle to all new customers worth up to £100 when you invest just £20. Sign up for a general investment account, a stocks and shares ISA, or a SIP and make your £20 investment to get started. Your capital is at risk. The value of your shares, ETFs, and ETCs can fall as well as rise, which could mean getting back less than you put in. New customers only. Offer is valid until the 15th of August for ISA, GIA, and SIP accounts. Other fees may apply, and T&Cs apply. Mark, equities have been a big part of your life. They've been a big part of my life. I am obsessed with markets and so passionate about the asset class. There's a new story every single day. Strip stocks and shares back for us, and what are they?
Okay, let's go right back to basics. When you buy a share in a company, let's say they have 100 shares for a whole company, you'll own 1% of the company. So you're effectively owning an equity or a stock or a share is basically part ownership of a company. That entitles you to certain things. It gives you the right to have some of their retained profits if the company was ever wound up. That's the profits they've built over the years and years. And if they pay a dividend, and not all companies do that, you will get a share of their dividends as well, which they pay out. It's a bit like interest on a building society account or whatever. And companies, mainly in the UK, tend to pay dividends much more so than the US. But nevertheless, it's something that you'll return in both ways. Either the profits grow or the dividends grow with this as well, and you get the returns from both.
So just to underline that, a dividend is a share of the company's profits that you're paid out, whether it's 6 months or every 12 months, and it's in the form of a percentage, just like an interest rate is.
Yes, well, it would be a sort of pence per share if you're in the UK. So let's say they've got a £1 share price, they want to pay a 5 pence dividend per share. Mm-hmm. So that's equivalent to 5% over the year. And you'd get that. And you can do with that 5 pence, whatever you want to do with it. You can reinvest it back in the company. Mm-hmm. And there are some schemes that let you do that tax efficiently, or you can take it down the pub and spend it if you want. It's a great thing to do, but it gives you the responsibility of what to do with that cash. And the management are effectively saying, here's a bonus, we're doing quite well, and that's it. They don't always do that. Sometimes they'll ask for some cash back, if they're having tough times. And that's one of the things about equities. It works both ways. And American companies are much better at saying, well, actually, we're going to try and invest all the money we make back into the business if we think the business is good, to grow the business faster and faster and faster. If you look at Amazon, for example, over, sort of 20 years, they didn't make any money at all. And then suddenly they started making money. And for those 20 years, all they did was reinvest every penny they got, every spare pound and dollar they got back in the business, getting same-day delivery, et cetera, becoming the most efficient retailer in the world.
Right. So the company can choose to reinvest their profits in their own growth, or they give you the money and give you the decision whether to reinvest it in their shares or to take the money and run.
Absolutely. And in America, there is much more of a trend from management there to use that spare cash either to reinvest in the business or to buy their own shares if they think their own shares are still cheap. So companies like Nvidia, Apple, Microsoft, they're all buying back their shares very steadily all the time. So actually, unlike something like cash, where the cash is growing all the time because you get your salary and everything else, you get your dividends and you can spend that. The number of shares in issue are generally shrinking in all the major stock markets. So it goes back to the supply and demand again. There is actually a very gently shrinking of supply of equities going on in most of the major markets, particularly in the US, to the tune of 2 or 3% of the whole entire market is shrinking each year. And yet demand, because people are becoming more wealthy, businesses are being more successful, the demand is actually going up, which is why, over time, arguably, equities should go up.
And does it matter how many shares are in the company? For example, if Chris and I had our own companies and I've got 2 million shares and Chris has got 100 million shares in him, does that matter? Why would we have different numbers?
Well, he'd be my mate, obviously. Well, this comes
my share price is higher, though.
Yeah.
I've got a lot more future earnings potential.
Yeah.
Well, I think like all these things, it doesn't matter about the number of shares you have, because he might have 100 million shares that are worth 0.1 pence each, and you might have 2 million shares that are worth £200 each.
Right.
Who's going to be better off? I think, you might be. But it comes down to one of the rights you have actually as a shareholder, owning this equity, is that you can vote.
A share is a share of the company. You have voting rights in the company. And you may well have rights to income called a dividend. And one of the great things about a dividend in a good company is it goes up each year. So it's not like a fixed amount every year. It goes up every year. So it's more and more valuable. Or they may not pay a dividend and they may buy the shares back.
Absolutely. Well, for example, the whole of the FTSE 100 on average yields 3.5%. So at the moment. So what would you get in a building society or a bank at the moment? You'd struggle to get that now as interest rates are coming down. You'd really, and particularly, particularly at the moment as interest rates are falling. But that 3.5% is also growing each year because the companies tend to try and push their dividends up by a little bit more than inflation each year. And that keeps investors happy. Americans have a different attitude to these things.
Most people at home are not going to be too bothered about the voting rights. You don't have to vote, right? You can just enjoy the dividends. But what about if a company doesn't pay any dividend and you want to buy a share that is going to see this incredible share price appreciation?
Well, the things you need to consider when you're looking at equities is the total return you're going to get. That comes from the dividend, as we were talking about, if they pay one, or it comes back to whether the company is growing by more than expected. If you think a company is growing by more than the rest of the stock market, or more than the analysts are saying, or more than your friends think, then you should probably go and buy a few shares. Because if they do that and they deliver, then the share price should go up. And the capital gain in that share price is far more powerful, in my opinion, than a dividend, which might give you 5%. Now, the companies that give you a 5% dividend tend to be very low growth businesses. They might generate lots of cash, but they're not growing very strongly. The companies that pay virtually no dividend or very little dividend are ones who are growing. And it's, as I mentioned, Amazon never paid any dividend. They didn't make any profits because every bit of spare cash they had, they reinvested back in the business. And if the business was at that point was doubling every couple of years, that's what you want them to do, because that will get them up and that will get the share price up. And that's what ultimately you're trying to get.
Right. Talk to us about expectations then, because Mark managed to mention there that you can't just say, oh, this is a great company, I like it, like it's a football team or something. There's a level of expectations of a company's profits and the profit growth. But sometimes it's already priced in. What does that mean?
What it means to say it's been priced in is that the management or the analyst community have already realized that company is going to grow its earnings by 20%. And therefore, when it announces its earnings have grown by 19%, everybody starts to go, shock, what's happening? It's gone down. I have this conversation all the time with my mother-in-law. Sorry, mother-in-law. But, she'll say, these results came out and the thing's down by 10%. And so the answer to that is the market was expecting better earnings than that. And although it made more money than it made the year before, maybe, it didn't meet those expectations. So quite a lot of the job of the finance director or the CEO of these businesses is to go around talking to investors and the community to make sure they put an idea in the heads of them of what they're going to make. Mark talked about it earlier, where there's a whisper number usually. So you'll find that there's an expectation from all the brokers that this company's going to earn 14 pence per share, but the whisper number is going to come in at 15.
Right.
And it comes in at 16 and everybody goes, oh, isn't it brilliant? It's beaten everything. Up goes the stock market. The directors say, aren't I brilliant? And everyone says it's fantastic. But of course, if it came in at 12 pence, the market would go down 2 or 3%. So it's all about expectation. One of the things we will be talking about when we get to the portfolio construction phase is what is the market expecting in terms of earnings? Do we think that's an aggressive forecast? Do we think that's a likely forecast? Or do we think that might disappoint? And I suspect that when we talk about the US market and we hear your very negative views, which I'm sure you'll be coming up with, Mark's very positive views, we'll be really talking about what's in the market. It's not that these companies aren't doing well. Yeah. It's what's already priced into these prices.
There is a price for growth, and that can vary. So I'm going to give you a couple of examples here. Over the last 5 years, Tesco's has grown its revenue every year by 4.3% over the last 5 years. Now, that's pretty rubbish, isn't it? Really,
it sounds rubbish. Is it rubbish?
It's basically because interest rates have been that high.
Yeah.
So they might as well have just taken the whole business, turn it into cash, and put it into building a society account. For the next 3 years, they're expected to only grow at 2.4%. I was looking at these numbers yesterday, and yet they're valued at slightly higher than the whole of the UK FTSE 100. So they're valued at about 15.5 times PE ratio. And they're just growing at a very pedestrian pace. But they're paying you a 5% dividend.
Mark, you've introduced something there. You've just said PE ratio.
Yes.
Could you just very quickly define that for a number of our listeners who probably aren't aware of what that actually means?
That was a subject at school that I, was particularly interested in. Is that what PE is?
Well, not on my Borstal, it wasn't. But anyway, so it's price, that's the P, and the E is the earnings. And the earnings is the amount of profits left after you've paid all the important stuff, like paying your interest charge, paying your tax, etc. So it's the net bit of profit that's left. And then you divide that E by the number of shares, and that's earnings per share, the price divided by the earnings per share, and that gives you a number. And then if you did that for all the 100 companies in the FTSE 100, you get about 15 times PE multiple, a price earnings multiple, and the FTSE 100 yields about 3.5%. And so Tesco's, they trade at slightly higher PE price earnings ratio to the FTSE 100, but the dividend yield is 5%. So it is actually quite a lot more than the yield on the FTSE 100. So there's a group of investors who say, I don't mind the low growth because I'm just going to take 5% a year in dividend.
And it's safe.
It's considered safe. What it is very recession proof, because when consumers pull back, yes, they stop buying the supercomputers and yachts and fast cars like you'd have, Rich. And instead they buy, they've got to buy food, they've got to have bread and milk and etc. And they get the basics. And they'll go to places like Tesco's. Right. They may trade down from places like M&S or Sainsbury's or Waitrose and go to Tesco's, Aldi, Lidl, Asda.
So really safe. But give us an example of what's the opposite then of a safe Tesco value?
Well, I mean,
there aren't many in the UK. That's the problem.
I'm going to use NVIDIA, right? NVIDIA, the world's biggest company. Why not, right? So over the last 5 years, it's grown every year by average 60%.
It's earnings.
It's earnings. 60% a year, right? So it's doubled and doubled and doubled again. This year, it's expected to go up another sort of 50, 60%.
Wow. So that's in the price.
That's supposedly in the price. And for the next 3 years, on average, that growth is expected to tail off. The analysts are saying, well, you have to do 50% this year, then you'll do 30, then you'll do 10. And it'll normalize in theory as people buy enough AI chips, etc. So when you buy NVIDIA today, you're paying what's called 80 times the price earnings ratio. Now, 80. So that is basically saying, I won't get my money back if I got my earnings per share each year for 80 years. Whereas with Tesco's, I'll get money back in 15 and a half years.
If profits stayed at the same level as they are today. And that's the key. Because you're getting that 60% growth, then the share price grows into, or the earnings grow into the share price, So
absolutely. So if you look forward 2 years, NVIDIA's shares are only trading on about 30 times price earnings ratio, because you've got such strong growth coming through. Now, it yields nothing. It's 0.7%, 0.07. It's just nothing. It's irrelevant. But if you think, and going back to expectation management, if you think they're actually going to double their profits again, then actually they're probably trading nearer to sort of 25 times PE ratio. Okay. So you might buy it and you'd still get another 30% potentially on the share price.
So to summarize, I think what it sounds like you're telling us is it's not just about this year's profits you have to look at. It is the earnings growth over the next few years. Is a company in an industry that is going to get bigger and bigger? Or is it, maybe you'd argue like tobacco, that the future is not great, or petrol cars, the future is not as great? If I was a DVD shop, then that industry is getting smaller and smaller, and the future profits aren't as big. So I have to make those kind of assumptions?
Well, you have to make a judgment on the management. And I think I can't emphasize how important it is to sort of make an assessment of the management of a company. And there are some managers, CEOs, finance directors, etc., who are absolutely fantastic at growing businesses. But actually, most of those are absolute rubbish at cutting costs. If there's a recession coming, they don't know what to do. They'll end up losing lots of money, and they'll be behind the curve in trying to get the business into shape for a slower economy. But when things are going well, they'll outstrip the growth over there. Those growth managers are great. And if you want to buy a growth company like NVIDIA, you want to make sure there's someone at the helm who knows how to grow it. Now, I remember years ago, BP was built buying loads of other big oil businesses and then cutting the costs aggressively, taking out the head office, cutting loads of people, cutting back, selling off assets they didn't need. And BP became the biggest company in the FTSE 100. The management, he was considered the biggest and the best. But he scared his management team so much because if they didn't deliver on the cost cutting, they got sacked or he sold that business. And so that management team started lying to him and not giving him true numbers. And when you lie and you don't get true management information, no matter how good you are at the top, if you're getting false information coming through, you can't manage the business until it's too late, because eventually it comes out. It always does. It always will. And sure enough, it did. So enough of these managers, middle managers, had not been telling the truth. They suddenly started missing their numbers. They had to make a reassessment of the value of all these companies they'd taken over. Their share price plummeted, absolutely plummeted.
Now, talking about profits plummeting and worrying numbers, we have had our first question from a listener. A reminder,
we've got one.
If you want to ask these gents...
Thanks, Chris.
If you would like to send in a question or a story or ask the advice of these two gents, it is theartofinvesting@ig.com. And that's exactly what our good friend did. And the question is, gents, what has been your biggest loss and how do you recover psychologically from that impact?
It's difficult to say what my biggest loss is because over the years that I've run money, there have been some very big losses. And before everybody thinks I'm completely useless, that's because I've run a lot of money. So if you run a lot of money, when you lose money, it's a lot of money. But the one I remember really clearly was in 2001, a long time ago. It was an issue called Railtrack.
Ooh.
So in those days, I mean, a long, long time ago, Railtrack was the precursor to Network Rail. It was running the rails and tracks, funnily enough, in the UK. And we held about 300 million corporate bonds in Railtrack. And one Sunday morning, I'm not feeling great this morning. I probably drunk a little bit too much the night before.
It's just any Sunday.
and my wife had gone out and got the newspapers. And so she threw the newspapers down on the bed, and front story on the Sunday Times was Railtrack to be nationalised, essentially, by Tony Blair's government. And I sort of looked at it and I thought, oh my God, this is going to be terrible. And we'd lost, I reckon we'd lost 50 to 60 million quid. And I'm sitting there thinking, oh my goodness.
50 to 60 million
50 to 60 million quid. What's 10 million between friends? It's somewhere in that range. And I'm thinking, this is going to be very, very, very difficult indeed. Now, as I've said to people before, an old saying from the banking crises, if you're going to go bust to a bank, go bust in a big way. Because if you go bust in a small way, the bank can handle it. If they go bust in a big way, it's somebody else's problem to handle the bank going bust.
And 60 million.
And 60 million is a pretty large amount. So what we needed to do was to therefore make clear it wasn't just our problem, it was the problem of the government. And I'm not going to go into the story because I know we're short of time, but we managed to, with other investors, go to see the government and get them to realise they were going to have their own taco moment. Treasury always chickens out, and they repaid us all the money of our bonds, so the loss suddenly disappeared.
Oh, I think we'll be coming back to this story in future weeks.
Much bigger story, but the question was, what did I learn from it? The first one is, and it's a crypto expression, DYOR, do your own research, right? We bought Railtrack bonds because it was government, we essentially thought it was government risk.
Yeah.
and they decided to foreclose on it. So do your own research, number one. Secondly, the second lesson, as I said before, is if you're going to have a problem, make it a big problem and make it somebody else's problem.
Sounds like make it the taxpayer's problem.
Yes, absolutely. It was. It was. Thank you, Tony Blair.
Right, on that, Spice.
Well, I did my own research. When I first started working with CJ back in 1990 with a company that I won't mention here, I just joined the company and I was an analyst, a fairly junior analyst. And my job was to go away, and there was a sector called Overseas Traders. And there was a company in there called Polypec. And Polypec was the NVIDIA of its day, if you like. It doubled and trebled and was a FTSE 100 company. It was the darling company in the FTSE, and it could do no wrong. And it was run by a guy called Azul Nadir. The name would be imprinted in my mind forever. Anyway, I went away and did my own research for the team. I went back, presented it to the team and said, yes, we own none of this share. We really should own some.
This was your baby.
And I said, I think we should buy this. So away we all trotted over the next few weeks, and we bought about £10 million worth of stock. And sure enough, I go and have my first holiday since I'd joined the company. And this is at the beginning of September in 1990. I pick up a paper on a Thursday afternoon, an English paper, and Polypec shares suspended. As all the dear, financial irregularities, investigation, all this. This company owned Del Monte, which you've all heard of, the orange companies and all the rest of it. And basically, he'd been doing dodgy stuff with the foreign exchange through Turkey. Irrelevant, because the shares never relisted. They went bust. So for all of our shareholders that in our funds, because they're shareholders as well, going back to the other thing, that price went from basically £6 a share to zero. And it stayed in the report and accounts as zero for several years until the tax man said, right, you can take it off now.
Right.
I mean, I then had to go to the main board of the company I was working for and explain why, having owned none of these shares, I'd said go and buy them. Now, talk about being dropped in it by your senior management. Thank you very much.
Yeah.
And Chris wasn't one of those at the time, but he was a colleague. We were working very closely together at that time.
And I love that this is going back to 1990.
Oh, 1990.
So we got many more stories since then, but we're just giving you a tantalising start.
35 years more of stories. Unfortunately, we are coming to the end.
I've got it. You want the lesson from this,
yes.
Right? If in doubt, if you don't understand something, don't do it. If in doubt, do nout. Right? If it's too complicated to understand, it's probably a wrong end or not worth investing in, because there are plenty of things you can understand.
Yeah.
The one thing it made me was an absolutely ruthless cutter. If I get something wrong, I sell it straight away and I get rid of it. I'm a cutter. I get rid. And for me, I clear my mind. I can sleep well at night, and tomorrow is another day.
If the story changes and if there's a real negative story, such as the central bank independence being lost,
or management changes or something comes out, get rid of it. And then you sleep better, you come out with a clear head the next day, and off you go again.
Excellent. Right, well, that is us coming towards the end of today's podcast. It's been another fantastic week, very enjoyable. If anybody's listening, should they follow and subscribe?
I think so, definitely. Yes, without a shadow of doubt. We are trying to help people and educate them in their financial journey. And we'd love everybody to subscribe and support and follow this podcast.
So if you have enjoyed what you've heard today, then be sure, as the gent said, to like and subscribe, give us a follow, tell your family, your friends, and anybody you think that has maybe mentioned to you, I'd love to get into this investing thing, but I really don't feel like I know what I'm doing. Well, now there's a way to find out. Any stories that you have for us, your successes, your near misses, then be sure to write us in at the email address, theartofinvesting@ig.com. We look forward to seeing you next week, gents. I hope there's no big losses to come.
Well, so do we. So do we.
Thanks, Rich.
Thanks, Rich.
Stocks bumped and dump. FOMC tomorrow. It's Tuesday, July 29th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York. 2 in Chicago today. Glenn Freiberger and Nick Batista joining us in studio. Welcome, folks. If you're joining us on tastylive.com or the platform Tasty Trade, thanks for joining us. Come over to YouTube. Tell us what you're trading, what you think of this pre-FOMC slumber. Very few shares traded today, gentlemen. Never cleared 1 million contracts on ES, as far as I saw. But it's a day where bonds bounce, gold and silver get a little bit of a lift. The US dollar tries to bottom. The news flow otherwise was fairly quiet, though we do get a US-China trade truce where the can has been kicked down the road 90 days. Nick, I want to go to you first here as we start to look at this market and break open this hour as the futures market closes at 5 Eastern, 4 Central. What do you make of today's light action where we started off overnight, pushing to new highs, only to fail there and close lower on the day?
Yeah, we've done that 2 days in a row, which has been pretty interesting. I mean, we had the Monday open where you had all the, soft tariff headlines where they said tariff deals, and then there was really, kind of no deals. It was a big old nothing burger, and then we sold off into the middle of the day, bounced back at the end of the day to basically be flat. Volumes are abysmal. You're getting a little bit of more of a rotation from some of the big name tech stocks. NVIDIA and the chip sector has been on an absolute tear. Those are unstoppable. You got a bid in Google, which was nice to see because I've been long it, but your Apples, Amazons, Meta, Tesla, not really participating. You got some other huge moves underneath the surface with UNH and some of the other ones. And then, just across the board, I've been getting, everybody's been saying, is this a dispersion trade? Is what's happening here? It's kind of been that way for the better part of the last 2 or 3 weeks now. It's felt like, every day it's a different group that's up, it's a different group that's down, and it's just a churn and cycle around the circle in that way.
Does that all end?
Never. Well, just quickly, when you say dispersion trade, are you referring to the fact that you're seeing a lot more volatility in individual stocks than you are in the headline indexes at the moment?
Exactly. I mean, you got big moves day to day in single name equities, and then the indices basically go nowhere. The slow grind to the upside. It's the fact that you see, NVIDIA up 3 or 4% on an overnight, move, opens up a couple percent, and the E-minis are basically flat. That's not really what you'd expect. It's kind of like it's getting weighted down by the other parts of the market that are on the downside, obviously, but it's kind of the idea that the single name volatility is way greater, in my opinion, and from what I've been watching, than a 15 VIX would suggest. 15 VIX tells me, you wake up every day and it's, 0.5% move in most of the big name stocks. You're not really getting that. You're getting 3-4% moves to the upside in half of them, 3-4% moves to the downside in the other half. So you're getting these big moves underneath the surface. Nothing moves in the indices themselves.
Glenn, welcome back to the show. It's been a few weeks. Tell me about the world from your point of view here, with risk kind of coming off the board a little bit today. Bitcoin's off a bit, Ethereum's off a bit, the dollar's a bit firmer, stocks are down. How does this all make sense from how you view the world? I know you had some concerns about the next 2 days because it's a jam-packed few days ahead.
Exactly, yeah. I agree with Nick here, but I have to be a little more optimistic. That times will be changing, at least from a volatility perspective. I imagine with the next 3 days here, the slate from a data perspective and from an earnings perspective, that the lull days are over. And as soon as tomorrow afternoon, we start to see some movement across these indices and across other asset classes. What do you think, Chris?
It feels like we're pushing on a string up here. I mean, why isn't the market able to run any higher with all this news and information? It's not lost to me that there's usually a pre-FOMC volatility and volume drain from the market.
Right.
And if we think about where we've traded this week, we've kind of bounced around, not too much in the S&P or the NASDAQ, a little bit softer net from the gap open. But NASDAQ here is holding up. It hasn't broken down. I think a lot of people want a reason to take some chips off the table right now. And I think you've learned in recent months that if you're not trading the market and you're an investor, you're best served with just sitting tight no matter what's happening. Because if you're an investor who overreacted in April, you may have been underallocated to equities, at least here in the US for the past few months. So you need a trigger to get people to stop staying long right now. Maybe good news is bad news again, guys. Nick, the GDP report that's coming out tomorrow morning is what kicks things off first. It's our week of abbreviations here, GDP, FOMC, and then, of course, NFP. GDP Now tracker from Atlanta today was revised higher to 2.9% for the second quarter. And while a lot of that's probably tariff give back, if you will, that's not going to give you a second consecutive quarter where you can then mark this off as recession. Do you think the market is going to be disappointed if we don't have recession data coming down the pipeline, as silly as that sounds, because the Fed won't be able to cut then?
Oh, it's a good angle. It's so funny because it's like one side is good, one side is bad, right? So you have the recession indicator, which is bad for all intents and purposes, but that means good things. You get to cut rates, and then if you have the non-recession indicator, then you can't cut rates. That's the not cutting is bad. So there's always one of each. I think this will be just like every other, big tech earnings / FOMC week that we've had before, where you have, and it's playing out just like the other ones. You have this event-driven volatility where, everybody's looking at the big name tech stocks. They have earnings. There's some volatility baked into that. You have FOMC, you have GDP, you have all the other 3-letter acronyms going on all week. And you get this little bit of a bit in volatility, which I'm happy to see. I would be more concerned if we were going into tomorrow with vol at lows and the VIX in a 13 handle, or at 1450 or something like that, where we were at earlier today. That would concern me more because that would be complacency. This is kind of good that there's a little bit of fear, which, and by little, I mean very little, considering that the VIX is a skosh off the lows. But it's good to see that, there's a little bit of hedging and liquidating going into these sort of things, because it tells you that, after the event, assuming nothing is so out of line, you probably have a little bit of a relief. And that's kind of been the story for the last couple quarters, despite, the one tariff, season that we had. It's always been, fear into JPOW. JPOW kind of balks or / kicks the can a little bit, or says, exactly what everybody's thinking. And then it's a little bit of a relief rally because you have that, okay, nothing bad happens. Let's move on.
Yeah, not a taco trade, a Paco trade. Powell always chickens out. How about that one?
I like that. He hasn't, though. He hasn't chickened out.
No, he's held the line. But I see a path that isn't as serious as, full-blown recession indicator, and a path to lower rates. I think we're set up from a timeline perspective in a relatively good way, where we have this FOMC meeting first on tomorrow afternoon. Odds are nothing of merit or substance is said. No change in any rates this time. But the next meeting isn't until September. What that will allow, in my mind, is not as much pressure on the rest of this week's inflation, GDP, non-farm numbers. We'll get 2, maybe even 3 more rounds of those numbers before a cut. And so in my mind, we could see slightly softer numbers, not necessarily recessionary warning, but consistent softer numbers that maybe we get some short-term volatility, some short-term drops in equities and other asset classes. But by the time September rolls around, what's already priced in maybe an actual rate cut that is good for equities.
Yeah, I mean, last year the rate cut in September was good for equities because we got to the other side of the growth scare and then the Fed just poured fuel on the fire. And so the economy was back in an upswing, and then you're providing lower rates. Stocks go to the moon. Bonds melt down because of inflation. the one of the technical signs here, Nick, I see today in my little notes that I generated here about the earnings in the market. S&P valuations are now starting to get above .com level era. And you mentioned volatility being low, and I'm trying to be judicious about this, but if we were to just take a look at the trend line here, the S&P really could not get back above its most recent uptrend from the April and the June swing lows. It's been bumping into it the last few days in July as the underside pretty neatly. And then the most recent move off the swing low that we have on June 22nd here, we're starting to find that come under a little bit of pressure. So the uptrend isn't dead yet, but it's downshifting right now. From your guys' opinion, Glenn, I want to start with you. If you're going to see a NASDAQ or S&P up 1% tomorrow, what would Powell have had to say for that to occur? What's the buzzword you're looking for to trigger you to go, oh, time to buy? And then vice versa. If you hear this buzzword, it's going to tell you, oh, geez, the Fed's leaving us out to dry here. I got to sell my stocks.
You have to sell your stocks?
Yeah. What are those words for you? What are your triggers?
I think anything, a crazy turn around the positioning for tariff uncertainty, if they change a lot of that outlook in either direction. If you see a buzzword around their shift in focus, I think right now they're looking all eyes on the labor market. If they all of a sudden have some caution for inflationary pressures that isn't already priced in, then I think that could surprise. Other than that, not really expecting too much.
What about if he steps down?
He steps down, yeah. Watch out. I don't know. Are you insta auto liquidating?
I don't think I'm not.
What if he's not wearing a purple tie? What if he picks a color?
Well, he debunked the purple tie. He rained on our parade there.
What?
Yeah, there was a interview that he did a while back now, but somebody asked him about the purple tie, and he was like, "Yeah, I like this tie. I just wear this tie basically every time."
All right, no tie. He quits on the spot.
No tie, rips his shirt open. Yeah, some of the guys on the desk were calling for him, or at least thinking that maybe he kind of mentioned something, or at least gives a little bit of
a nod
to
an early exit.
Yeah, which would be
I'll take your action on that.
You don't think so? You think he fights it to the bitter end, Chris?
If I thought that Powell was going to hint at that he's going to step down before his term ends, then I would be buying the 1 DTE. Let's go to 1 DTE here in gold.
So you're going to gold? You're not going Bitcoin or shorty minis or something?
No.
Straight to the hard stuff.
Yeah.
There's our Powell resign trade. Risk 40 to make $4,960 in a gold call spread.
I like it.
So 200 points on gold. Gold up 10% minimum.
Oh yeah. Yeah. Gold would clear gold might get up to like $4,000 tomorrow if Powell were to announce he was. I mean, if he were to be fired, that would be the worst case scenario. But yeah, so purple tie, time to buy, Nick. No tie, time for stocks to die. Is what you're thinking? Like Powell just goes up there, listening to Grateful Dead, takes down his speakers.
Yeah, completely unshaven, a little hungover.
It's been
real. Just drops the mic. He's like, "Yeah, you guys are screwed. I'm out."
Grabs the microphone.
Yeah. Okay, so I mean, listen, tomorrow's meeting, no change is expected. It's 2% chance and change right now. The odds for the September cut are moving up. They were 63% a few days ago. We're now peering in closer to 67%. 2 dissents are expected tomorrow as well. Those have been well choreographed, I think, in advance, so it shouldn't surprise anyone. We haven't seen dissents from the Federal Reserve since September 2020 under Powell. So this would be a unique circumstance. They have been a board that's been in lockstep. But I don't think it's a surprise to anyone because we've heard these officials say in recent weeks, if it's been a governor like Bowman, or you've heard from Wash or Waller, right? Current Fed official, former Fed official. If I were at the July meeting, I think we should be cutting rates. So the dissent, don't think is the shocker. It's, I think, the conditions that Powell lays out to ultimately see a necessity for the September cut. Because, folks, 4.1% unemployment rate, stocks near all-time highs, an economy that's probably growing after the GDP adjustment, we'll call it 2% plus in real terms for the second quarter, but likely rebalancing to a 1.5% level thereafter. That's not the strongest case for an imminent cut, especially if inflation's still sticking near 3%. That to me says gold is good, silver is good. We had a small bounce today, though. I got to say, I'm really concerned about both of these up here. Glenn, starting with you, this is a market that's closely tied to FX, particularly because of the dollar and its outperformance the last few sessions. Do you find gold and silver's strength today in the face of a stronger dollar something that's noteworthy?
I think the most noteworthy part of it is looking at the range where we've been, and that over the short term, regardless what the reaction is, there's more room to run than we've seen earlier this year, where we're checking in at events like this, pressing on all-time highs or just off them. And so here, I'd say, now more than a lot of other times previously this year, it wouldn't surprise me to get a 1% move, a 2% move in gold, and not even yet be at those levels that we were at in just a couple months ago. So,
realistically, we could go down 2% and not touch the late June low, and we could go up 2% and not touch the July high.
So I'd say a lot less pressure on these metal markets to perhaps move more freely. Mm-hmm. Not sure whether the attention will be there or the trade volume, but that's what's interesting to me.
What's holding it there? What's the chop fest here? Gold.
It's Chris Vecchio's call spread on the outsized Powell move.
that's keeping it contained.
Yeah, no, it surprised me. Not too sure. Like you said, maybe it's with that. It's a good sign with some of that VIX pop that people are keeping some exposure up there, but not sure what causes it to fall apart.
It feels like with those 100+ IVRs a few weeks ago, Nick, people have just been hammering selling calls up here in gold. Mm-hmm. And we can't really make much progress. But at 33.80 and change right now, I think Glenn has a decent point. If we're thinking about gold the rest of this week, you need more than a 2% drop to get down to the June low. You need more than a 2% rise to get to the July high. It's only a 19.2 IVR. Do you look away from this? Do you focus more on single equities? Is this an area of interest for you? Do you play it through GLD, or who cares about gold? We have Bitcoin to trade.
That has had more of my focus, but I do have a position in gold. I've been playing it with iron condors and kind of leaning into these moves. So into the rally that we had in the middle of last week, I took off the put side of an iron condor that I had on a wide iron condor to take advantage of some of this vol. So into the up move, I took off some of the long delta via that short put spread. It lost pretty much all of its value, given that we rallied 150 points in gold. And then into the down move, I actually was not obviously at the bottom, but on Friday last week, I added that put spread back, a new one, a little bit closer at the money. So I'm kind of like scalping between this range, this kind of tight range that we've had in gold. With the volatility where it is, it's been, a fun trade. It's been there's been some juice there to squeeze. So it's a tradable thing recently.
Yeah, it has been. I know that Mike and you and Ilya have been doing directionally neutral or even leaning long deltas, but vis-a-vis short put spreads. Mm-hmm. And so the market's staying up and volatility is getting out of it. That's kind of the ideal situation if you want to be a short put spread. If it goes directionally up, that would work too. But being long calls, right? It's been flashes in where it's like, this looks like a great trade. No, it's not again. Oh, it's a great trade. No, it's not again. Yeah. So it's been more frustrating from my approach than it is for yours, even though has gold done anything?
No, it's at the same price it was a month ago. And that's why but you've had this, nice two-sided action that allows you to kind of leg out of these positions, which is, not something I typically think of doing in gold because gold isn't really a mover. So it's nice to, have that tool in the toolkit right now.
Glenn, let's switch focus to the US dollar here, which for the second consecutive day, it closes above its 50-day moving average. Hello.
Yeah.
Haven't seen you do that all the way since the middle of February.
Seriously.
Something's changing here.
Definitely a reassuring sign here for dollar bulls is just that from a magnitude perspective, we've seen the drops twice as much as any sort of strength back in the dollar. Here now we're not only building on it from the weekend trade news, which in months past we've seen just evaporate by Tuesday. Any positive sign for the dollar over the weekend or on Monday's open. So yeah, we're not only seeing successive days, but we're seeing magnitude of the euro dollar move yesterday to the tune of more than 1%, and just building on that, I think is a very reassuring sign that we haven't seen since, this year at all, because it's just been euro crushing in terms of 2-3% moves and staying where it is. Dollar not being able to fight back. So not sure if the slate of events we have this week, it's also, we're still only 200 points away from those highs. So if the data tells the right story, not a ton holding it back from being at those lows, but at least going into these events, building stronger than we've seen in a long time.
Nick, there's got to be some good news for dollar bulls here with these turns in the last few days. Are you playing this?
Yeah, I've been a dollar bull for more than just these last 2 weeks, so I felt the pain. And so I feel sort of vindicated here after the last couple days. I will say volatility in the euro itself, if you're trading the euro futures, has been relatively high. It's been a great trade just selling upside call spreads kind of around that 119, 118 level. It's, I've had 2 or 3 of them over the last month or so, 2 months maybe, that I've traded in and out of. And so I've been doing that in the euro itself. I've been trading some of the FX products as well, which are starting to come in a little bit today and over the last 2 sessions here. So I've been trading mostly the euro in the futures market and then dabbling in some of the other FX components. But yeah, this move, I've been waiting for this. I could use a little bit more, a couple more days of this.
Very much so. I see a market here that looks like it's ready to turn. The pound right here, 6B on the screen, it's losing the neckline of a potential head and shoulders pattern. The Canadian dollar is losing its uptrend from the low that we had in February, April, mid-July. Likewise, maybe that's a sign of a potential top. The euro already gave way yesterday, and now it's back below the 50, so losing all sorts of support very quickly. By the way, this is one of the largest euro long positions in the futures market ever, for what it's worth.
Oh, when I was doing the data review, so good. That's a contrarian trade.
Week. Yeah, through the end of the week last Tuesday, because the futures reporting period for the COT is Wednesday through Tuesday. So we'll find out the data this coming Friday at 3:30 Eastern. But from the most recent report we just had on Friday, the positioning was continuing to go up. So a lot of people smacked yesterday because it's an exceptionally crowded trade right now.
Yeah.
Glenn, that's why I asked you about gold, because the 3 most crowded trades coming into July were long gold, long Mag 7, and short US dollar. And so there's part of me that sees this turn in the dollar as something that may be problematic for gold and silver to make meaningful advances in the short term. Especially if the dollar is making these kind of moves when yields are coming in, because you as an FX person know the dollar and currencies typically follow rate differentials. And so if the dollar is able to bounce back with lower yields, then what does gold really have? What does silver really have driving it to the upside at that point in time?
Yeah, you bring up a good point, because that's the other variable in this week's slate is.
Okay.
Yeah.
Yeah. So, hey, do not resuscitate. Do not resuscitate.
Yeah, we do have a DNR here.
Yeah, it's a company-wide DNR.
That's good to hear.
You come to this place,
only
you work
for
at
Glenn.
if you had lights out at this place, that's it. Okay.
I actually am the AED retriever for this office. We have
Are you?
Is that the official name?
Yeah, we have a lot of 60 and above crowd.
Yeah, we do.
They've timed me because the AED is on the first floor, so how fast I could actually get it. 30 seconds if the elevator's working.
Like hazing here.
Seriously. No, but what I was going to say is I'm very interested to see if we have a correlation breakdown with gold, with yields, just given, what storyline takes over this week. We have our pick of them. And so if it's equity-led, does that leave gold out of the picture? Does that present different opportunities? And does the dollar recouple with some of these rate moves? I don't know.
That's one of the odder things today, given the correlation between rates and the dollar in recent weeks, where it's actually tightened back up again and has been behaving quite normally to a certain extent. You don't really see that today. Lower yields, stronger dollar, kind of a buy America view in there. But then you look at gold and that's up and stocks are down. So not a super fantastic mix. Speaking of the mix here today for stocks, the sector performance is pretty evenly split when we look to our sector ETFs here, basically right down the middle. We've tracked 25 here on overtime. I see 10 that are in the green, 2 that are inched, and then you have another 13 that are red. I don't see any significant thematic idea to follow through on here because on one end, retail is performing terribly, the worst performing ETF today, tariff sensitive sector for what it's worth. That's in here off by a whopping 1.69%. But then so too is discretionary and healthcare. On the other end, real estate's up, GDX is up. Nick, you mentioned semiconductors earlier. That's plowing ahead to a new, I guess technically a fresh closing high today. So the AI revolution not dead yet. Do you guys have big concerns about the second half of the week, Glenn? I think that's what you wanted to get into, because for most retail traders, when they think about event risk, or at least the way that they learn how to approach markets, it's kind of like, you may have your methodology. It could be quant, it could be technical, but just be aware when you have these things that pop up. If it's an earnings report, if it's a GDP release, they're idiosyncratic risk. Nick, I think that this is a pretty dense time now between the 4 major tech earnings and then all those acronym reports.
Yeah.
Do you find yourself approaching the market differently because we're at all-time highs ahead of this wave of event risk? Are you doing anything unique this week? Any different strategies that you're pulling out? How are you handling it?
I'm playing for a little bit of catch up in the big names that have not participated in the upside. So mainly Apple. I'm also a little bit of long delta in Amazon, but I'm neutral to long. I'm not playing for, I think my view this week is kind of a limited upside with more potential downside. It's almost like a long put spread trade. So I'm playing for a little bit of a catch up to keep a bid in the market in some of those stocks that have been beaten down. Just given where volatility is, where the market is, I'm naturally starting to put on some downside positions, a little bit of a hedge trade. I had this conversation with Mikey of putting on a little bit of short delta doesn't necessarily mean I'm bearish. I'm not bearish to a crash, a 20%, 50%, whatever it is. I don't think that's in the cards, but I think a routine, 4, 5, 6% downside move after what we've seen that brings us back, a month is totally normal and reasonable given where volatility is, given where stocks are, given all the events that are coming up, all the earnings coming up. Even if you call it profit taking, all those things kind of play into a little bit of a pullback at some point here in the near future. So that's where I've kind of started to gravitate towards. And I'm taking off a lot of the stuff that's worked, that volatility is now completely out of those products. When you look at NVIDIA at an 11 IV rank, which is kind of up today from where it was yesterday. It was like 5 or 6 yesterday. The stock is a double from the lows. Like, how do you get more long that? Like, if you've been long it, you're taking off delta here. Like, you're not adding more delta. It doesn't mean you're bearish, but it's hard to get more long now after what it's done. And I think there's a lot of stocks where you can paint that story, and that's kind of my thesis for maybe there's a little bit of a pullback.
Is your downside risk plays? Are you playing with the time horizons there? Are you doing anything more short term in that regard because of the week, or is it, like you said, just kind of liquidating some, getting more neutral some?
It's so as you go up and you take off those long delta, like I was trading in gold, that naturally leans you short because you're taking off long delta, right? You're not getting short delta. You're not putting on short delta. You're getting short delta via taking off long delta. And so that's a lot of what I've been doing. The other things I've been looking at are things like QQQ and SPY and doing diagonal spreads or something where you're kind of calendarizing and buying further out premium where, volatility is so low now that
that's exactly what I'm doing.
It's paper cuts for a week or 2 weeks as we grind higher. And then, you get a 1 or 2 point pop in vol and a 0.5% or 1% down move in the market. And those diagonal spreads or calendar spreads, they return you, 30, 40% in that one day. Like those are the sort of trades. It's a slow, painful death for 2 weeks. But if you do get that little bit of a down move, it hedges your positions pretty significantly. So that's what I've been looking for. I've been looking for a little bit of a pop in volatility, no huge move, no huge delta. I'm not static delta. It's mostly dynamic delta. It's mostly long volatility, long gamma as well a little bit too. So that's how I'm doing it in the options market.
I've been doing like that synthetic short calendar spread, I guess, where like I'm long the short dated NASDAQ calls and call spreads, and I've been long the longer dated S&P 500 puts, just to think like we're going to keep flying up into the sun. And I don't, I want to be there while we keep going up. And in case the wings melt, then I have some protection in my pocket.
And you leg out of those calls. The shorter term, like you're doing the exact same thing, a little bit different than what I'm thinking is that, because as you get these moves higher, you're taking off those calls, which is reducing your overall long delta. It's getting you more short into these moves. I mean, that's exactly what I've been doing with my positions.
Well, it's certainly I think this is actually a very tough environment to trade, Nick. Like holding on to a bull market while it's melting up on no news and low volume. You kind of start getting into like, okay, something's got to happen here.
Yeah, it's awful. It's been awful for a month. It's been
Can I pose a thought experiment here for us?
Sure.
What if we were to discount all of the price action between April 2nd and May 1st? And we were to just say this is the market rebalancing and dealing with the trade news. But let's envision a world where from April 2nd onwards, the market just chops sideways for the rest of the month. And then in the beginning of May, we start this uptrend. So forget the really aggressive rebound trend from the lows that we have in April. Let's just start from the beginning of May onwards. This is actually a really sturdy, stable uptrend.
We're fine.
Yeah. You get the Men in Black little like pen and just like zap your memory of tariff talks and all that stuff. You can't erase history like that, Chris.
But we have deals now.
But do we? We have. Okay, so if we were to follow this path forward, right, and think about how a market correction could unfold, right? Assuming, let's just say the trend stays in place, this listless, everything's fine, we're not going to overreact to tariff headlines. May onwards, this becomes the channel, because I can make an argument. This is 1, 2, 3, 4, 5. There's been a lot of touches in here. We have a correction that lasts a few weeks. Maybe, Nick, you talk about your little pullback here. It brings us right back into the trading range from earlier in July. You get your another leg up into the end of August. You clear 6,700. And you get a ping pong path here where into the end of the year, we can play this game. Nick, you and I have talked about longer term price targets for the end of the year. If everything worked out well and we were to continue the current recovery path that we've been on since May, not that I'm saying we will, 7,000 S&P doesn't seem outrageous, which comports very neatly with the 1998 scenario that many people are talking about, mainly May. But it would comport very neatly with the 1998 scenario where you get a little bit of chop here for a little while, and then into the middle of August, your chop's been going on for 6 weeks then. You've actually had a market that's been flat from the late June onwards, and you've now cleared the cobwebs. Maybe we've survived a little bit of a volatility bump. But the uptrends don't look terrible, right? It's only when you measure them from the most extreme point of the low, they look really bad. Otherwise, to me, these just look like channels that have hit channel resistance and are still doing the cadence of a little bit up, a little bit down. We're all friends here. Let's just keep this party going kind of situation. No reason to overreact.
How does your .com level analysis play in here if we keep churning higher? When does that kick in?
Nick, when did the .com bubble burst?
It was after 2000. I mean, it wasn't. Was it? I mean, 2000, 2001. But the worst
March
of it,
2020. I mean, March 2000. We could call it.
Yeah. But it didn't end until mid 2001. It went from. I mean, it wasn't like a V bottom.
No, I bring that up because in the analogy, if this is 1998, then that means this could get a lot stupider with valuations.
Okay.
That's my point. I can't go back far enough on the chart. Unfortunately, we only have 20-year look back period. But that's kind of what I'm getting at. We're seeing they're talking about sending out tariff relief checks.
Money printer go burr.
What do you mean we need tariff relief checks?
I mean, emotional compensation. I'll take $1,000.
I'm shaking. I thought the other countries were paying for it. Why do we need rebates on the tariffs then?
That's a good point. I didn't think of it from that angle.
Fine, then I get yours, Chris.
No, I'm not one of those people. You're going to give me the tools to make more money and put more, cheddar cheese on the shelf, then I'm just going to play within the confines of the game.
Yeah.
Begrudgingly, but I'm not going to. I don't like people who fight with one hand behind their back.
Yeah.
There's no moral victories.
Yeah.
So that's why I say, how does this compare?
Glenn, come on,
right.
Too nice. No
more Mr. Nice Glenn.
Okay, relax. This is only your third time on the show. So we have GDP tomorrow. We have FOMC tomorrow. We have our earnings tomorrow. We got to talk about oil here a little bit. And it's not just because Glenn said he wanted to talk about it, but this is a geopolitical risk situation. President Donald Trump yesterday hinted that he was moving up Russia's 50-day deadline to strike truce with with Ukraine. Okay. Today, Donald Trump formally moved that up to 10 days from now. So I suppose we no longer have a August 1st or an August 12th tariff deadline. We have some amorphous, we're going to punish Russia deadline 10 days out here. So oil prices are going up. It's a 3.72% rally today. The week has seen an explosive move already in very short order. We're talking about nearly 6.5%, 7% now from the lows on Friday to where we are right now. Glenn, your question is, when do we fade this? Nick, I'm glad you're here, but this is usually the Radigan question. It would have been apt for him. He likes to wait a few days, 3 days, 5 days, feels out the situation before he starts thinking about fading geopolitical risk in the market. How do you handle oil here if it is indeed moving for the ascribed reason that I've just suggested?
So I unfortunately it's fine at the moment, but I am in an iron condor that has a little bit of short delta in oil here, up to like the 71-ish handle. Oil's been a great trade outside of the 1 week kerfuffle we had in the Middle East. It's been a great trade pretty much all year long. So that's been kind of something that I have. So I am in it right now. I I guess if it's so easy to say, oh yeah, I'll wait the 3 days. And then if you miss it, you feel like an idiot. I think at this point, if you are looking at getting some short delta, I would probably consider doing a call spread. Maybe you go a little bit further out of the money, just size it a little bit smaller. And if this continues for 3 more days, you have more ammo to get into those positions. But it's hard to say, I'm going to wait. Like I would love to wait for, the pop and vol to start, getting into some of my positions, but you can't wait around.
Legging in.
Yeah, you stay small and you get some now, and you have the ammo to reload if it continues, and then you don't miss the downside.
That was Josh Fabian's point of view today. He sat in on Futures Power Hour.
God, that makes me sick. Oh, shit. Oh, man.
Back to the drawing board.
So before we immediately lose money on this, I do think to your point and Josh's, there is merit to that move. I'm still sitting in my short iron condor, which I'm perfectly content with because there's 50 days to expiration, even as uncomfortable today was. Mm-hmm. I'm looking at what a decent trade setup would be to try to size up a short call spread if I wanted to leg into something. And I got to say, Nick, at these levels here, I'm not loving it as today or tomorrow even being the day to start legging in. Because if I wanted to get something in that 60 to 70% profit, I still got to do a 4-to-1 here.
You're not getting the pop in volatility yet. So you've got,
not yet.
In oil volatility has gone from like, let's call it, 33-ish. It's sitting at 38% right now, which is still pretty high. I mean, it's on the higher end of where we've been. It's more towards like the middle. It's not quite the higher end of the 40, 50 IV that we saw, kind of in the tail end of the Middle Eastern conflict move. So if you think, that like in Dylan's mind, to give Dylan his props, that move, if this happens for another 2 days or there's more kind of development in this situation, that's probably going to be the perfect spot. If that happens.
Is this not a validation though for a directional bias like that? If we aren't seeing the pop in volatility, maybe you're not getting paid as much for it, but better to be right.
You're saying you get the down move afterwards, like because
Right.
it's all over, like you're not getting the fear. Like that's just kind of a short-term thing.
Maybe not.
I respect that.
But yeah, in my mind, at least this does give you a place to look on a Tuesday where everything else is pretty subdued and requires a lot more, perhaps, conviction. Here, you're on a completely different clock if you elect to play on the tariff, or what is it? It would be sanctions shot clock of 10 more days to play nice. So
this is inflation too.
Yeah, we got what, PCE on Thursday?
Yeah.
So
that's another part of this, right? If this was an inflation move, I would think that we'd see it more in the long end of the curve, right? Where the inflation expectations reside. And so if oil's going up and bond yields are down the way that they are today, the dollar and the yen are two of the top performers, makes me feel less inflation worry pass through and more about like this is geopolitics and people are trying to get some safety in their pocket. Nick, you mentioned something about this, selling a call spread here. What if people want to play it both ways? Could they have the best of both worlds by, would you call it like a synthetic covered call? You're buying maybe MCL and selling a call spread in CL here. Sure. Is that something that you find interesting?
Yeah, it's a Mikey Butler favorite. You get the benefits of having a little bit of static delta to the upside. And then with the call spread, you have that short volatility component. And you can kind of manage them dynamically. And because of the span margining, there's relief on both those positions. They're very big positions that you can get kind of, that are reasonably, your capital outlay is reasonable, even in a smaller size account. So definitely, I certainly think that's an interesting way to trade this. Yes, for sure.
Yeah, like a bull call ladder, basically. To just cap your upside risk if this thing keeps squeezing, and if it goes up a little bit more and then we start to teeter out.
You can hit on both.
You can take You can hit them both. You take off the MCL long and you let the short call spread ride a little bit.
Yep.
Maybe that's how you leg into it, right?
Mm-hmm.
You're selling the call spread, and that way, if this thing keeps rallying, you got something in your pocket. And if you have to adjust your strikes on the short call spread side, it's offset by the gains you have in MCL.
Yeah.
I'm not personally trading this long. I'm looking for that Radigan approach. Glenn, to answer the question that you passed me over Teams, would I sell this year now, basically, or when would I start to try to fade the move? I think it's going to be a move worth fading. Let's just game this out. Trump's threatening Russia, a nuclear armed state. Are we going to go to war with Russia over Ukraine? Probably not. We're already 2 years in, but are we going to see American boots on the ground? Right? Even Trump with Iran, that was escalate to de-escalate. So we're talking sanctions. That probably makes people uncomfortable going after the Greek shadow fleet, or maybe even pass-throughs with India and preventing India from, does that hurt a trade deal? There's so many layers to this. The point is, realistically, are we going to see more kinetic war than what we're seeing right now? And I don't mean to downplay the death and destruction, because I feel like the Russia-Ukraine war has been swept into the background as people's attention has been focused more on Israel-Gaza in recent weeks again. But you just search Kyiv or Odessa in the news, and you're going to see that Russia is still sending waves of drones and missiles into major urban areas every single night. So, are we going to talk about nuclear war? Is that what we're really worried about and pricing in right now? What's also interesting here is this move higher in oil. You see how much energy that the EU says that they're going to buy from the United States?
Was it 700?
Yeah.
750.
700. Did you guys know that if we were to sell that much energy to the EU, we actually don't produce that much energy?
No.
Well, there's no timeline. Yeah. Damn. Who gave
Nobody
you the wrong
thought
number?
about that, and everyone was happy. And you had to think about it.
We would have to stop selling oil to everyone else that we sell oil to satisfy Europe's demand for what it's worth. So either that's not happening, or we're about to drill, baby, drill. Which, again, could we do that? Well, we just put all those tariffs on copper, steel, and aluminum, which makes buying drilling equipment that much more expensive. So what's the path here for oil? Let's just say Trump gets his way. We sell $750 billion worth of energy, bless you, to the EU every year. And we still maintain all of our relationships otherwise. We're going to have to double our oil output. How is that going to impact? So, okay, where's the upside right now? What's the upside shot? You got to tell me. I don't see it unless World War III. But even then, we always fade World War III, because if our counterparties get nuked, we're never going to collect on our debts. So might as well fade the action.
I'm with you.
Glenn, does that suffice? Wait 2 to 3 more days?
That suffices.
Glenn's not calling for nuclear war over here, okay? He's not trying
It wasn't on my bingo card, but
Yeah,
now it is.
Yeah, well, he's no longer a Glenn guy or whatever we're saying, a good Glenn.
Yeah, good Glenn. He's a bad boy. He's a bad boy, naughty boy. He was just in Amsterdam for a little while.
I was.
Yeah. He's been telling me some stories. He's naughty.
But we're back.
Yeah.
American Glenn is an Eagle
American
Scout.
Glenn.
Yeah, yes.
Keanu, you really like the Strupen waffle over there, don't you?
Oh, yeah.
That's why you went.
The Bitterballen?
Yes.
Yeah, good. That's usually why people go to the red light district, Glenn.
Mm-hmm.
Here in gold, we saw the breakdown before, and in silver. We've covered commodities a little bit as well as we go into the end of the session. Okay, 5 minutes left. Topic of the day choice, perhaps. What do you guys want to discuss about here into the end? Glenn, you first. Pick Nick's brain.
Oh, gosh. Talk about a dark place. Let's see here. I mean,
I've never been to Amsterdam. I don't have those same memories.
I mean, Nick, are you doing anything in the bond space, or is that not your cup of tea? If not, then what are you thinking about earnings tomorrow?
I have had a small long bond position. I got out of half of it today. I'm long ZBs at the 113 handle. So I am long bonds. And and it's been a pain trade for the last week, and now I'm taking about half of it off at a scratch, and lightening up the position. So I'm there. So I'm not as long bonds. For their earnings, I told you I like the stuff that isn't sitting at highs. I like Apple. I like Amazon. They're not the sexiest, but I think there's a catch-up trade. You saw it in Google. Google, everybody, it's left for dead. Search is dead. Google's dead. And then, there's a little bit of a relief that, maybe Google's not dead. And we can, bid this thing a little bit higher. I think earnings as a whole are going to be bigger moves to the downside. The up moves are going to be very much inside and up. So I think skewing your risk with a little bit of short delta makes sense. That's why I'm hedging, a lot of my positions with the ETFs and SPY and the Qs. That's kind of where I'm getting my short delta and stuff that I'm not playing directly for earnings.
Chris, what about you? What's your where's your eye at?
I'm trying to think of the absolute best and worst case scenarios for the market over the next few days. And obviously earnings matters a lot. Maybe earnings matters more than the GDP data and the non-farm payrolls data. Maybe because of the tariff give back, people don't care about GDP, even if it's going to look good. And we want for the more timely non-farm payrolls reading because that's July and that's third quarter data. I said it earlier, there are some times when I have pound the table conviction and, I'm sending texts to Radigan and Ilya, like blindly screaming by, this is an apeshit moment, buy the dip. And I'm pounding the table and I'm just long ES futures. Forget being long MES or just an ES call spread. I'm just long ES. I have zero gradients right now in that direction. I feel very strongly that this market we are Icarus flying into the sun. But it takes 8 minutes for sunlight to reach Earth from the sun. It's hundreds, millions of miles, right? So maybe it's going to take a little bit longer for these wings to melt because the past 2 years, this has been an economy that's been so resilient. Where's our recession thanks to the Russian invasion of Ukraine and the ensuing Fed rate hikes? Where's the recession from all the end of the COVID era spending? Where's the recession? It never came. It happened in some places, but not for the broader economy. Maybe we're just muddling through. And if we're just muddling through, is that bad for corporate earnings? Probably not. Are people stressed and overextended? Yeah. But as long as the checks keep coming in, then debt can be serviced and the music can keep playing in the short term.
Where are you keeping it really short term? GDP tomorrow morning. That's the next thing on the docket. Where are you looking for a reaction? Are you looking?
I want to see core GDP. Well, first off, I want to see the core GDP figure.
Okay.
Core GDP would be stripping away government spending and the import exports. So we're basically isolating what the private sector is up to. And that was strong in the first quarter. The underlying rate of growth was close to 3% in core GDP, which is one of the reasons why I was like, this isn't a big deal. It looks like it's tracking closer to 0.8 to 1% right now. And that would be a meaningful deceleration that would raise eyebrows. So you could have a scenario tomorrow morning where GDP is close to 3%, but core is 1%. And people think, you hear of administration officials talking about panicins and people that were chickening out in April, when in reality, the market's going to see it and go, oh, geez, this isn't good. And the Fed's not going to cut today. And now all of a sudden we are on a deceleration path and no help's around the corner. So that would be bad news. I want core GDP. I need that to be high. That's the gravy. If we have core GDP up, then everything else the rest of the week probably doesn't hurt on the macro side. Otherwise, macro is going to be a little bit more intense. But you know what? We're ending down the show here today. We learned a few things, including that Glenn apparently travels abroad to Amsterdam, and Tom has some interesting Instagram habits.
Yes.
But with that, overtime is out of time. I want to thank Nick and Glenn for sitting in. Tomorrow, Ilya and Dylan will both be back. I may not be here because this dang attic has got to be cracked open and they got to pull this air handler out. So I stopped sweating in here.
Good luck.
That's right above my office. So until then, good luck trading. See everyone soon. Up next, more Tasty Live. Stick around. Yeah.
What is going on, everybody, and welcome back to Risk and Reward. We're back with Ian Gus. Got a new risk of the week. We got a lot to get into this week, brother. We got a lot of movement going on. Eli Lilly, Google, Meta, Microsoft, Apple. A lot of earnings, a lot of binary events. How are we holding up so far in the middle of the week?
Yeah, I was ready for the earnings to be what brought on the volatility this week, but the pharma sector is experiencing some
a lot of volatility, no doubt.
Yeah, a lot of things happening there. It's interesting. It's like there's all of a sudden this giant competition for all these weight loss drugs, and everybody is just they're all hurting each other. Like everybody, yeah. Now all of a sudden was it a bubble? Were weight loss drugs a bubble? I don't know. But yeah, doing pretty well. It's been a rough week for me in the market, but fine week personally. You know, this shit ain't everything. So
I hear you.
Yeah, feeling pretty good. You guys had us laughing in chat before we hopped on here. Funny stuff going on. Good to see everybody. Emmett, Grumpy, Luis, what's up? Big Deal, what's up? Edward,
what's going on, guys? Everybody. How are we doing today, guys? Hope we're doing well. We got another earnings week, and is there any specific before we get into the details? Is there anything that's sticking out like a sore thumb for you? And if you guys are looking at anything, let us know what you're trading, what you're looking at. I got my eyes on Meta, some other names I want to look at. Anything in particular for you?
Yeah, I would say broadly with these tech stocks, I'm mainly looking to see if this momentum can be sustained.
Right.
All tech stocks have just been on such a rip to the upside since the Liberation Day lows,
right,
and only continue. Yeah. And so it seems like for all of these companies, Microsoft, Meta, Amazon, Apple, all these companies having earnings this week, it's going to take some pretty big beats. I feel like I think we might be one of these situations where we're pricing in a little bit too much, or there's too much complacency in the market, and we could see things return to the downside. I don't know if there's anything I'm going to necessarily play myself, but I am hoping we get some of those downside moves to present some buying opportunities.
Yeah, I mean, we can go ahead and jump into the slides here because to dive right into it, I mean, my position was based on a little bit of the fact that we've ripped 5 consecutive weeks to the upside, Gus, to the point you made with Liberation Day. So market's been rallying, not good for my NVIDIA position that I put on a few weeks back for one of the risk of the week. Still holding on. So that's not going on the tally, not on the chart yet. We still got some time on there left, but we can jump into the slides, get into the risk of the week.
The slide deck that I just copied from was like 6 weeks old, and it was your Disney position that expired on the 18th of this month. And so it's been like, that was like 6 weeks ago. You've been trying to get short against this market for a long time.
I think it was
You've moved across the country and just continued trying to get short on the market.
Bro, it's because I came over here and it's humid too. Like, I think I need a change of climate. No, but we'll get into these slides here. Let me make sure I can have great view. Awesome. Risk of the week plus catalyst of the week. Gus, what do you got for risk of the week? What are you feeling this week?
Yeah, I'm going Novo Nordisk. Rare risk of the week, we actually have outlined 2 different positions that I'm in here, one of them being shares with no time horizon, and the other one being leaps. But Novo Nordisk, as we alluded to at the beginning, took a huge dive this morning, and potentially a unwarranted dive. They said that there's more competition happening with Wegovy, so they took their 2025 sales growth forecast from 13 to 21% down to 8 to 14%. A 30% dive, I don't know that that's necessarily justified purely based on that adjustment, because we're talking about sales growth numbers. We're not talking about revenue or something. This is growth. This is new. This has nothing to do with the fundamentals of the company. Competition is definitely increasing for Wegovy, but the demand isn't going anywhere. I think I've said it on air before. America is only getting lonelier and fatter. I like any companies that rectify those 2 things. Like I said, fundamentals are still very strong. They have earnings coming up on August 6th, and I really like, this is an opportunity that I really like and rarely get, and you were able to kind of do it with Delta Airlines or United Airlines off of Delta Airlines earlier, but it's when the big negative thing or positive thing comes out in advance of the earnings call. So now we've all of a sudden done all this to price in this terrible information. I have a hard time seeing how anything could happen in that earnings call that forces us to 2 far lower lows. And it's been as high as $92 this calendar year, currently trading at $53.94 at today's close, as high as $133 in the last 365 days. Obviously, weight loss drug hype was propping it up a lot towards the end of 2024. I was about to say 2022, man. These years are really
all bunching together at this point.
But yeah, it's been as high as $133 in the last 365 days. This is a 3-year low for the company in general, and it's just feels like a good buy spot for a company with great fundamentals that isn't going anywhere anytime soon. And also, I don't know why, but the market seems to have this perception now that these pharmaceutical companies are just weight loss companies, and I think that that's a thing that it kind of tends to happen with these pharmaceutical companies because, during COVID, they were just vaccine companies. It was binary. Do you have a vaccine or not? your stock will move accordingly. And now it seems to be that way. Are you able to sell weight loss drugs or not? It's binary. And if you can't, your stock's going to tank. But are you telling me that Novo Nordisk has done no growing outside of Wegovy in the last 3 years? Like, it's crazy.
I mean, NVO's definitely taken a hit today. I mean, looking at the IV, it's out there. But I mean, today's taking it. NVO's taken a hit today. But if you look at the sell-off that I had a few weeks ago, IV spiked a lot higher than it did on the move today. And today felt really aggressive because it also dragged down one of my positions in Eli Lilly, like that we were mentioning a little bit, because they're kind of working off each other. They're competitors in the space.
But yeah, I mean, 30%, like that's a hit. UNH's CEO got shot and they only dropped 50%.
Right,
so we're talking about 30%? Like, yeah, it seems too crazy.
Speaking of United Healthcare too, I think we got United Healthcare earnings pretty soon.
Yes.
So that's going to be very
next week.
Yeah,
but yes, very
a lot
soon.
of eyes on that one. With that being said, NVO risk of the week. I like that. I'm also going to be keeping an eye on NVO as well.
Leaps. I don't have any crazy time horizon on this. The top leap that's listed, that's mainly a gamma play. If we even get like a $20 upswing, all of a sudden that premium is going to go through the roof. And the shares, I'm holding for a little while. I think that, I don't know, 70, 80, 90 is in the equation in the next year or so.
When it comes to the weight loss drugs, it almost feels like, is this just a bubble? Is it this or that? But those weight loss drugs or that industry as a whole has like a cycle of like every 5-year or 10-year increment periods where you see some new supplements, some new gear, something within the fitness space. And to the point you made earlier, it's going to be an industry that's going to be profitable and around for as long as we live.
Yeah, and the analogy that I have continued to draw this entire time is that these weight loss drugs are like the AI of pharmaceuticals. You say semaglutide, you say GLP-1, and your stock goes up, and nobody asks any questions.
Pretty much.
And so, and much like the way I question AI in the tech space, not the future of AI, I agree it's the future, but just the way that these companies are able to do little tiny AI integrations and get share price bumps off of it. I also think that perhaps the share price bumps that people get when they roll out a weight loss drug is unjustified. It just happened to Hims because they rolled out generic semaglutide a week or two ago. But yeah, it's very interesting, and it very well could be a bubble. And also, I mean, people. There's always going to be some people that need help with weight loss, but this is a rare drug that kind of eradicates the need for itself. I mean, that's true as well with, I'm sure there was a medicine to treat cholera at some point that we don't really need anymore. But generally, the pharmaceutical industry likes to operate on a keep you for life sort of model. And this is one where you just do a treatment and then you're good.
See what we get with this healthcare industry, fitness. A lot of volatility. That's why it's risk of the week. That's why we're putting these positions on too. A lot of volatility. Mine, I know. It might seem a little lackluster. We can go ahead and jump to the next slide here. It seems lackluster, guys, but hear me out. Yes, I'm trading SPY right now. SPY was what I chose for the week. I sold it at a money cost spread, wanted to get on some negative delta. But I mean, we're 5 consecutive green weeks to the upside and an upwards drifting market that has a history of returning 8 to 12%, something within that range on a year-to-year basis. So that's my justification for having this in risk of the week, kind of getting ahead on the short side. This one is a little bit further out in time, sold this in the September cycle. So I'm not trying to time it too much, just I believe that we're a little bit overbought at these levels. Things are feeling a little bit overcrowded. Things are extremely optimistic at these levels. And I know after we put in all-time highs, I know what the data says. But we're going to be selling an out-of-the-money cost spread on SPY. We're going to be collecting just about a third of the width tomorrow. We're going to send it through tomorrow. I was checking out the chain today. It's only about $1.80 something for these strikes right now, but I'm going 50 something days out in time. So it's nice to be able to collect at least $2 to minimize that risk and have $3 left to risk, but we'll see if we get that. That's what I'm eyeing SPY. Go ahead, call me a boomer. I don't care. I'm going to accept it at this point. I'm not trading bonds yet, though.
I'm definitely for it. I mean, complacency is definitely at highs right now. Everybody just keeps buying, and we keep expecting this market to only go up. Breathing periods are natural and to be expected. You got solid strikes here to even give yourself a little bit more room should you need it. I'm with this. I'm seeing it. I do think it's perhaps a little boring.
But, it is a little boring.
But I'm with it.
I hear you. I think I can. That's valid. I like that take. But that's what we got for the week. We got Gus's NVO, SPY for me. We'll come back on Thursday, give an update on the positions, and go from there. but we do have some earnings.
Absolutely. Yeah. We got all kinds of earnings this week. Tech sector is going crazy. We have 4 companies in the Mag 7 going off this week. We're just going to run through these quick bullet points. We don't, earnings can get boring and get too far into the weeds. So let's dive right in. We can go next slide. Microsoft, first one. They report Wednesday, July 30th after the close. Consensus estimates outlined on screen here. EPS of $3.37, revenue of $73.8 billion. Obviously, solid marks. We've also took the liberty of including a fun fact in each of these to keep everybody interested. So, Bill Gates was arrested in New Mexico in 1977 for driving without a license and running a stop sign. Did you know that? Maybe you did. I realized after reading this that I had seen his mugshot before, but it had never clicked, or like I thought that was some kind of promotional thing or something. Mm-hmm. But yeah, no, he really did get arrested. Sentiment-wise, they beat Q2. Are they not reporting Q2 earnings? Is this their Q3? I never know what fiscal years people are on. Anyway, beat estimates last quarter. Led double-digit growth in Azure Cloud and AI revenue. And all eyes will be on, oh, never mind. I was going to say AWS. I'm getting ahead of myself here. They have Azure. Errol isn't confirmed. Yes, but Microsoft coming up. They've been on quite the run-up to this point. It's interesting because right now, like some of these stocks that you would consider to be like, I don't want to say boomer stocks, but like less exciting companies have been on some of and the best runs.
As in what, like the blue chips?
Yeah, yeah. And even like IBM, like I mentioned last week that this run that IBM is on, I can't believe it. Yeah. And yeah, that's a company that I feel like a lot of people had largely written off. So Microsoft been on an absolute tear. Like I said, I think it's going to take a lot to create any further upward momentum. But maybe they can do it. In this age of AI, you never know. People just pull money out of nowhere.
Right. Now, then this week, Wednesday, July 30th, we're going to have Meta earnings. EPS is going to be $5.88, revenue $44.8. Fun fact for Meta, the first item ever sold on Facebook Marketplace was a couch that the seller said reeked of cats in the description. Oh, so we got a little bit of customer feedback with the first use case of Meta there.
Yeah, yeah.
Also, do we want to add anything else on Microsoft before we jump right to Meta? We're good there?
I think we said our piece there.
Cool. But yeah, little fun fact there. Sentiment, Wall Street overwhelmingly positive on Meta's AI-heavy pivot. AI is not as much of a buzzword as it was 6 months ago. Analysts expect 5 to 6 months or 5 to 6% post-earnings swing. Price targets between 750 and 800, given AI-driven and ad revenue growth. As you know, some of these price targets are very aggressive, are very optimistic. But I mean, on a personal sentiment, I believe in AI personally. Will we get to 750, 800? I mean, I hope we do. Will we? I have no clue. When will we get there? I don't know, but I do like Meta. I'm looking forward to the Meta earnings as well.
I think the same way. I mean, I certainly buy into AI, being the future. However, what I think is interesting with Meta right now is these insane, like NFL-style contracts that Mark Zuckerberg is handing out to anybody he can get his hands on pretty much right now. I mean, they're doing $100 million signing bonuses, $300 million contracts for these top-level AI machine learning engineers. And, while it's obviously a very valuable thing, is there really... I mean, are you really telling me that there's going to be one employee that justifies $300 million? Like, that seems a little bit extreme. But I think that a lot of things that Zuckerberg has done over the years would have seemed a little bit extreme at the time. I know he got called an idiot when he bought Instagram for $1 billion. And they said that was an overpay. Yep. So perhaps he's just willing to overpay for things that he knows are going to do well.
Yeah, and I mean, I think when you're in a position like that too, it's like you can afford to overpay for these things. It's like I can afford to take this loss too, so I can afford to speculate on this business, this company. I do super well with Facebook. It is crazy to think about that. He only bought it for $1 billion, Instagram. And it's not like Instagram was a very thriving product at the time.
Oh, no.
A lot of users.
It was an overpay. Everybody vilified him for it. It wasn't making, it made no money.
Right. And again, it was one of those things that you took pictures of whatever you thought. It was like for photographers. That's what it was geared towards. Anyways, cool to see what it develops into today. Because another thing I want to add on that piece before we shift gears is the photo dumps. Any other unks or anybody unks or boomers that are not on Instagram, seeing the guys between 15 and 30, that age range, photo dumps are very common. And it's almost like these photo dumps are gravitating away from people just posting just selfies all the time, which that still happens. But I think it's so interesting how Instagram is going back to its first use case. Yeah. People were posting those photo dumps before. It's stuff they just thought was cool, or they seen an angle and they want to edit it and then post it. And it's like, I see people taking pictures of cool things again. And that's what originally Instagram was used for.
Well, yeah, it's sort of interesting pathing. And I know that like make Instagram casual has like been a push that people have been trying for the last couple of years. And it is slowly working. I do think that slow turnover is happening. And yeah, it's really interesting because Instagram came onto the scene and it was kind of like this casual thing. Some people used it for nicer pictures or whatever. But I think what is really interesting in that whole calculus is Visco, which popped up, and that took the artsiness away from Instagram. And so I think that right there at the beginning, like 2012 to 15, those are kind of arbitrary years. But when Visco came around and began to gain popularity, that was when Instagram was at like peak casual, because you would go to Visco to post all your really good pictures, which is interesting to me.
I got you. Grumpy Mike's post selfies, hundreds and hundreds of them. And
Hell yeah.
We'll go back and spam those
Drop
likes.
that.
What do we got? So next year on the slides, we got QCOM. What do we got here?
Yeah, QCOM, they go off Wednesday, July 30th after the close. That's the last that will be going off after the close of this set on Wednesday the 30th. And consensus estimates are an EPS of $2.71, revenue of $10.3 billion. Qualcomm, sleeper, gigantic top 20 company in the world. Don't feel like it gets the media coverage of a top 20 company. But they've been around forever. And in the late 90s, they released the Global Star cell phone, which is the only cell phone ever created that could also function as a fax machine. The thing is insane. Guys, go Google a picture of this phone, please.
No.
Holy cow.
No.
It had like you had to put like a paper tray add-on if you wanted to use it as a fax machine, but it was like wide enough to just do it, like gigantic.
Off the bat, is this practical? Can
No.
you see a use case for anybody in a very specific?
Absolutely not.
No,
I actually read that even in their internal reports, there was 4 people that ever used the fax functionality.
Is that because of cost? Difficult to get this piece of technology?
I mean,
or
yeah.
just not practical again?
I think just
all the
impractical.
above.
I mean, yeah, who's sending a fax from their cell phone? Like it just
no.
And then
I haven't heard that word in a while.
Scanners pop up right in there somewhere, and I'm not really seeing that. But it did exist. Go Google a Global Star and have a nice laugh.
Yeah.
But yeah, Qualcomm, this one's going to be very important to me personally. I am incredibly long Qualcomm. But most pertinent right now is I have an August 15th 170 call that is naked. Closed at 162.08 today. So not exactly trying to ride that to in the money. I'm $18 in the green right now. So teetering very close to break even. And this earnings could absolutely tank that position for me if it does not go well. So go kill them, Qualcomm.
Kill him. Qualcomm was one of the risks of the week, was it not for you? If it wasn't for you, I think it might have been.
I probably have sometime.
Yeah,
I'm sure. I really like this company, and I really like them moving forward as well. They do Snapdragon, and I think it's all really good stuff. Whoever just isn't Hims just Viagra with snake oil? That made me laugh. No, Edward. I think that they do a lot more. Maybe at one point it was just Viagra.
Said, can you fax that to me?
Maybe at one point it was Viagra with snake oil, but these days, Hims is doing everything. Well, that's Hims and Hers now. Yeah. They got. If you're losing it, they got it.
I feel like you can come up with a good slogan. If you're losing it, something.
It's true. If you're losing it, because I was about to say I was thinking about all the stuff they do. Yeah. I'm like, if you're losing hair, if you need to lose weight. If you're losing your ability in the bedroom, they
just slide that in on the third one. Not too soon, not too far at the bottom.